The main event this morning, Chairman Powell, 2 hours and 30 minutes away. Going into that, equity futures down about 0.2%. Good morning to you. On the S&P, we're negative. On the Nasdaq too, down a little more than 0.1%. Into the bond market, big move lower in the 2-year to start the year. Over the previous 2 days, down 25 basis points on a 2-year. We tried to bounce this morning, up 2 basis points to 4.23. Elsewhere in the FX market, the call from Goldman, you know it well now, dropping their recession call on the Eurozone. Euro dollar through 107 and maybe having a look at 108, 107.40 on euro dollar, up by about 0.1%. This, of course, can all change with the words of Chairman Powell later, and inflation coming up on Thursday. Investors questioning whether we have seen the peak. Atlanta Fed President Raphael Bostic weighing in, saying, quote, if the CPI comes in showing the same kind of trending that we saw in the jobs number, that will make me have to take 25 more seriously and to move in that direction. But we still have some time to go before that. So that's Bostic, Tom, on the size of the move at the next meeting, 25 or 50. He was asked, once we get to 5%, how long we'll stay there. Tom, do you know what he said? 3 words, a long time. So it's really about how long they stay at terminal. That's the tool they're using to really push back against these rate cut calls we're seeing elsewhere.
These well-meaning people, including a frontline economist like Mr. Bostic, they're very visible. They're in the Q&A, the press conference, wherever they are. And John, it's real simple. Do we want the presidents of the Fed gaming 25 or 50 beeps like a derivatives trader at SocGen?
Hasn't this become the game?
I just won't participate. I don't
actually
agree.
think
you hold on a second. Hold on a second.
Well, no, it matters. And I think it does matter because what they're trying to do is set up a 25 basis point rate hike that isn't viewed as a dovish signal, that they're backing away. And they're trying not to ease financial conditions more, but build in some insurance. It's a real issue that they're trying to make that is very difficult, but that is what they're trying to signal. And that's probably
I think what they're trying to signal is they have to get to Thursday's inflation data and retail sales. I believe it's next week, the 18th.
Hold on a second.
I believe.
You hold on.
I'm holding on a second.
I agree with you, though. It's true what you said.
See, they're piling on.
It's quite straightforward. It's just Brown so fired up this morning. So fired up. Chairman Powell, Tom, 2 hours and 28 minutes away.
I'm going to have a Tang Zero break.
Is that strong?
I agree with each other.
Is that one strong?
I don't like the aftertaste. It's like Coke Zero. It's just not the same as it could be. Let's get some intelligence on this. Lindsay Piegza with us, chief economist at Stifel. Lindsay, I'm going to cut to the chase. Our audiences, our viewers, our listeners, their heads are spinning. Atlanta GDP now is a stunning 3.5% plus guesstimate of where we are. The fourth quarter looks pretty good after all the gloom. Where is the assuredness of economic slowdown in this 90 days, or dare I say even Q2?
Well, I think the assuredness comes from the weakness that we're seeing on part of the consumer. As a consumer-based economy, if the consumer is not out in the marketplace, happy and healthy, we would expect a meaningful decline from that more robust pace as we saw in the second half of the year. And against the backdrop of negative real income growth, higher borrowing costs, and of course, many consumers facing the risk of variable rate debt resetting in the first quarter at higher levels.
Well, that's right.
This will compound the pressure on consumers.
Lindsay, you're reading my mind. The chart yesterday, I believe Zero Hedge had it. Thank you, Zero Hedge. And it was, I think, a Bloomberg chart. I can't remember. Of the credit card interest rate is a variable rate. I mean, we're all looking at housing and that. But fold into your analysis credit card rates that were 21, 22% that are now 28, 30%. How does that play in to the caution?
Well, it plays in significantly, particularly as savings are now drawn down to near zero levels. Remember, the consumer was very much supported by this accumulation of wealth during the pandemic and the immediate aftermath. We estimate there was an additional about $6 trillion in terms of a wealth cushion supporting consumers. And that removed any sense of immediacy to revert back to the normal labor force participation formation that we'd seen in previous cycles. But now as we go forward and consumers draw down that savings, we're seeing this return to a reliance on credit card debt. Now, arguably, the household balance sheet is beginning from relatively a healthier position than in previous cycles, but still, we don't have this unlimited amount of wiggle room for consumers to take on that new amount of debt. And particularly as that debt is now repricing at higher levels, this will compound that pressure, as I said, on consumers, limiting their ability to go out into the marketplace. That doesn't mean that consumers are going to fall off a cliff, but that does mean a meaningful loss of momentum. And again, as the key part of the economy, it's going to be nearly impossible to maintain then that level of 3% growth as we turn the corner now into the new year.
So, Lindsay, would you push back against some of the optimism that we've been hearing from people who've been pessimistic through all of the second half of last year?
Well, I think the timeline for the pessimism to set in was extended. Consumers did prove to be surprisingly resilient through much of this turmoil in 2022. But again, it doesn't negate the fact that these outlying variables will weigh on the consumer and limit their ability to spend. There's only so much savings that we can draw down. There's only so much credit card debt that consumers can ramp up. And so just looking at this from a quantitative perspective, regardless of our qualitative optimism, the numbers suggest that consumers simply will not be there in the first half of the year.
Does changing the timeline change the depth of whatever downturn you're expecting to happen? In other words, does it make it less or does it make it more as new excesses build up now?
Well, I think the depth and duration in terms of the downturn is very much going to be hinged on monetary policy and the sticky nature of inflation. The higher that prices remain, the longer that prices remain in this uncomfortable level relative to what the Fed can withstand, that's going to force the Fed to raise rates higher and potentially keep rates higher for a longer period of time. And that's going to be the scenario that's going to compound that downturn and the duration of that downturn.
You know, Lindsay, I know you hang on every word we do. And Julian Emanuel is just on with Mr. Edward S. Hyman and their team in Asia modeling 6% plus China GDP. Not that I don't need you to tell me that's what we're going to see, but if we get 5.8, 6.2, whatever, what does that do to exports and imports in your U.S. GDP math?
Well, certainly it's going to be difficult to get to 6%. That's extremely optimistic. That being said, it does seem as if there's nowhere to go but up when you're talking about an economy emerging from a nationwide shutdown or more restrictive zero COVID policies. But that being said, what we've seen thus far has been far from an ideal reopening. It isn't a flip the switch scenario. So it's more going to be a slow bleed, particularly against the backdrop of a number of black swans that continue to float around, those with over-heightened optimism, new variants, a lack of natural immunity to the virus. Any of these resurgences, as deemed by the government as inappropriate or intolerable, could lead back to many of these zero COVID policies. So I do think it's overly optimistic to think that once the door cracks open, it's going to swing wide open and get us back to that structural fluidity that we saw prior to the COVID pandemic.
John, Pigza there was on the edge of Bramo. I mean, that's what I noted there. I mean, you know, she's on the edge of Bramo this morning.
I think a lot of people waking up this morning feeling like they've been told conflicting things. We've
Oh,
got this
huge.
survey data
In the
that's
last
sub 50
3 weeks?
for manufacturing and services. Then we've got this big boom that people are talking about over in China, and they're wondering whether they should be pricing in slower growth or a growth rebound.
Yeah, Lindsay, what's so important here, to go back to your earlier insight, is variable rate. John Farrell lives this in England. They're the land of the variable rate, the floating rate mortgage, and all that. How big a deal is the variable rate in America? I'll get it out.
I think it's a very big deal, particularly when we go back to the conversation we had about consumers. When we're talking about credit cards as a key support to consumer spending going forward, as that interest charge continues to rise, that's going to limit the ability for consumers to access alternative sources of income aside from returning to a more traditional position in the labor market. Now, this could actually be somewhat of a double-edged sword, but a positive in the way that if consumers feel they can't rely on these alternative sources, that may create more of an incentive for these sideline workers to move back into the labor market and help increase that labor force participation, which, of course, as labor demand outpaces labor supply, we've seen this upward pressure on wages. If we see the reverse occur, that could put some welcomed downward pressure on wages, something the Fed is certainly looking for.
Just real quick here, if you choose a data point, you can tell your own story. You can pick whatever data point you want to edify your view. That has been basically the belief for the first couple of weeks of this year. Which data would you be watching most closely for a true read on the pace of how the economy is developing?
Well, I think when we turn the page looking at the consumer, I think negative real income growth for the better part of the past year tells a longer term story about the unsustainability of positive spending activity. And that is really going to be the driver of 2023, whether or not the consumer can continue to shoulder these elevated prices against the backdrop of negative real income growth.
Hey, Lindsay, thanks for this. Lindsay Piegza there of Stifel on the US economy and the global economy for that matter, ahead of the Federal Reserve Chair, Jake Powell, speaking a little bit later this morning. Big change from the team over at HSBC. Max Kettner this morning, I think this got the attention of many of you. Having been staunch bears for more than a year, for much of 22, we think the consensus is wrong about a weak first half and a second half rebound. The team at HSBC went on to say we see a variety of reasons to be less bearish on risk assets in the first half, with depressed growth expectations being key. Tom, he was max underweight equities for so much of last year.
Oh, he's the gloomiest guy we visited in London.
Without a doubt.
No question.
We're going to catch up with Max at 7:15 Eastern Time.
We are. I didn't know
so
that.
About 35
Nobody
minutes
tells
away.
me anything.
And that's a big change from him and the team.
Yeah, it's a big shift here, and you fold it into what Steve Majors talked about. And if you get an Edheim and disinflation, what does that do to Steve Majors' long-term caution on the certitude of higher rates?
If you get an Edheim and Evercore China GDP story, 6 handle.
That's something we
was
will
not
remember
thinking
and
about
monitor 6 to 9 months from now.
Totally, Lisa. A couple of months ago, I don't think anybody was thinking about 6 handles out of China GDP for the year ahead.
Nobody was thinking about them elevating the debt ceiling levels and how much they were going to offer to the stimulus as well. So there are a lot of different factors here, not just the reopening in China.
Can I say, Yui?
Well, it depends on what too, but sure.
Okay, well, you and I both, all three of us, I think, say enough on Bitcoin and SBF, whatever his name is. This is heating up, folks, in the last 24 hours. Now, we've got Coinbase just out moments ago with layoffs, and it's 950 people, John, but they only got under 4,000 people. So it's like a 20% cut or whatever. But the bombshell here is yesterday, Forbes magazine had an article, Javier Paz over there, of the money walking out of this Binance. I have always said I'm way more interested in the investigation and the allegations, speculation about Binance than any of this SBF stuff. That's what I'm watching in January.
And when we get some news, we'll bring it to you.
We front ran that on the crypto show. You can see that today at 1
I don't think we want to front run anything.
We're just out front on the crypto show today. We're selling it.
We're going to talk about foreign exchange next.
Should I have a beard like Miller? What do you think?
It depends. I like you with a grey beard. After a vacation, when you're a bit more chill. You know, you don't want a grumpy beard.
Is it the beard?
No, you want a chill beard.
Yes.
There's a chill beard, then there's a grumpy beard. You know, when you come back from vacation, Tom, it works.
Ho, ho, ho.
Mark McCormick coming up next from TD from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The UK's attempt to send the first satellites into orbit from its own soil has failed. A rocket launch from a Virgin Orbit Boeing 747 that took off from England malfunctioned. That led to the loss of its payload of 9 satellites. The jumbo jet and its crew returned safely. After years of drought, California is in a long flood fight. Since the end of December, waves of storms have rolled in off the Pacific Ocean. They've killed at least 14 people, closed highways, and forced residents to flee. On Monday, there was an evacuation order for the town of Montecito, home to Oprah Winfrey, Prince Harry, and Ellen DeGeneres. China is striking back at countries for imposing COVID-related curbs on Chinese travelers. Beijing has suspended issuing some visas for South Korea and Japan. It's China's first attempt at retaliation after a number of nations implemented testing requirements for travelers from the country. Apple's push to make more components for its devices in-house is hitting more suppliers. Sources tell Bloomberg that the tech giant is dropping a key Broadcom Wi-Fi and Bluetooth chip in 2025. Apple also reportedly plans to make its own first cellular modem chip by the end of next year or the following year, swapping out electronics from Qualcomm. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You got to think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Starting point is the SEP, putting it between 5.25 and 5.5 if memory serves. That's a reasonable place to start, but we're going to need to go in and imagine as the data roll in, do we need to go higher or can we stop a little earlier? I think something above 5 is absolutely, in my judgment, going to be likely. But when I say absolutely going to be likely, I still have uncertainty bands around that, but that's where I'm putting it right now.
That was Mary Daly. So much Fed speak in the last couple of days. The San Francisco Fed president speaking to the Wall Street Journal just yesterday. We'll hear from Chairman Powell a little bit later this morning. Equity futures right now on the S&P down about 1/3%. So much optimism out there around Europe, just relative to the pessimism that existed a couple of months ago this morning. The likes of Goldman dropping its recession call on the Eurozone. Right now, euro dollar 107.37. We're positive there by about 1/10%. The move in the dollar since the highs of late September, DXY down by almost 10%. That's some real dollar weakness, Tom, that's come through in the last couple of months, and much more so, again, in the last couple of days. We heard from Mark McCormick recently of TD. This is what he had to say about the dollar. In 2022, inflation, momentum, and carry were all the rage. Now the focus has shifted to value and growth. Keep in mind that terms of trade still matters, but the momentum has reversed in favor, Tom, of the importers like the euro, yen, and Korean won. Another shift from last year. The Korean won, TK, last couple of days, major moves. I think levels we haven't seen going back to last summer, last June.
That's I believe that's on the Pacific Rim, and that's what I'm looking at as ADX-DMY. This is a really important conversation. Let me frame it with you before we go to the wonderful Mark McCormick. On a technical basis, I am dead set on the death cross. I think it's absolute total Mickey Mouse mathematics. There are other things related to it that are really important. And there's a 3-moving average exponential study, which has finally shown weak dollar trend just in the last couple days. There's other indices that people like Mark McCormick or Jordan Rochester use to confirm that. They haven't confirmed yet, and that's a setup to go to Mark here right now. He is with TD Securities. Mark, I'm going to cut to the chase. We're going walk like you and I used to years ago. Wells Wilder in 1978 looked at momentum and came up with something called ADX-DMY. It is yet to signal weak dollar trend, but on BBDXY, ADX-DMY is awaiting a trend. Are we going to get that trend? Is it going to confirm a moving average study?
Yeah, I think we are. I think we're moving in and out of regimes. That's been really the way we've been set up for the whole pandemic, that we kind of get 3 to 6 months, maybe even a year of one thing, and then we move into the other. And as you mentioned, we're kind of moving totally out of the inflation regime. We're moving into something new. And I think that new regime is really going to be focused on how the global economy is reacting, how certain countries have divergence across financial conditions. But a big thing that's going to really drive this is, again, the reversal of the terms of trade and the repositioning of equity markets. And the optimism around equity and the optimism around growth it's not really optimism per se, but really stabilization of the global economy and moving out of stagflation. So that will help confirm the trends in the price action because the macro regime is changing.
In the last decade, one of the people codifying regime change has been James Bullard. He has talked in the last number of weeks, maybe a month, maybe 6 weeks, about the trajectory to higher interest rates. He's stunned with a 7% number. Can your world stay pieced together in stability if we get Mary Daly's, say, 5.25%, dare I say 5.5% terminal rate?
I think 5.25 is manageable. I think part of it is really the journey, right? So a lot of the price discovery and the volatility that came across different asset classes, we think call it macro volatility, the VIX, the move, currencies, all of that had to do with the discovery of where the terminal rate's at. And I think even if we go, our expectations that we go to 5.5, I don't think that needs to be a tremendous shock to markets, but it does shake up positioning. So our view is that in the very short term, we could see the dollar consolidate a little bit, maybe give back 1.5%. But the next move over the next quarter, the next 2 quarters, is a 5% move lower against particular currencies. So we're in this environment where positioning and technicals are going to matter, but we are moving into a momentum-based regime change that is going to be ultimately bearish for the dollar.
Mark, where am I getting that 5% move? What against?
I think it's against a whole host of things. It's going to be, if we look at, we're still extremely bullish on the yen. I think there's a very good amount of upside for euro. If we can get down back to about 105, we can use that as a level to buy into for a move through 110 for the first half of the year. I think the other currencies, again, as we talked about Asia a little bit, Aussie, Korea, those guys look quite appealing in this backdrop. And I guess there would be a little bit of a rotation to SEMA as well, on the back of a stronger euro, which would also probably support Poland.
And Mark, I saw the move yesterday in dollar won, the Korean won, dropping to its lowest level since June. That's some won strength. Everything in Asia was stronger against the US dollar. Can you tell me where the Aussie fits in? You mentioned it there. How important is that trade going to be?
Yeah, Aussie's quite important because what it is, it's one, a reflection of kind of Chinese growth, and two, it's a reflection of kind of the dynamics around what's happening with commodities. If you look at commodities over the last 3 months, the sector performance, which is what matters for FX, kind of the composition, is really the most important factor. What we've seen is energy prices have underperformed and industrial metals have outperformed. So this is a focus on the Chinese reflation trade, which again is somewhat in its infancy. But as you can kind of see, consensus is stumbling over itself to push up Chinese growth for this year. So Aussie fits into it. One, if Asian equity markets are outperforming, Aussie's just going to kind of be lumped into that backdrop. Two, if Chinese growth is performing in terms of trades improving in Australia, that's going to give the RBA a little bit more confidence as well. And it's also going to be supportive of capital flows and trade flows into Australia.
Mark, within these interdependencies, if we get Evercore ISI's stunning 6% plus GDP call for China, what does that import into America in terms of the inflation guesstimate out 6 months, out a year?
Yeah, that's an important question because as we just talked about, the commodity prices, particularly different parts of it, maybe not energy, but other things will move higher. So we do have a bit of a tug of war where China could introduce more inflation into the U.S. economy, but at the exact same time, all the supply side mechanics, if you look at the Fed's supply disruption index and also PMI delivery times, all those things are also linked to China closing and to China lockdowns. So I think what we have is the supply side, which has been, really kind of not focused on it over the last year because people have been focused on the demand side of how we can reduce inflation that way. I think the big thing is that China reopening basically helps the supply side continue to improve, even if it's somewhat stimulative for inflation from the demand perspective. So on net, we probably have still inflation moving lower, but maybe it kind of settles at a higher level with China reopening.
Well, link this into Priya Misra's work. I mean, she's just been phenomenal on inversion as well. Dominic Constam over at Mizuho says risk assets can win this year. That's an outlier call, I would suggest. Do you and Priya suggest risk assets can win?
Yeah, I think they could. It's largely a function of kind of linking the things we talked about around stagflation. And again, from an FX conception, you think about three things. You think about global economy, where we were in September when we talked about the peak of the dollar. China was never going to reopen, and the Eurozone was going to have a very long, drawn-out recession based on energy prices. We got the miracle weather that people were looking for that was a very good cushion to get Eurozone past this through their recession. And again, the data is coming in better than expected. Yeah. Terminal rates are about to peak. And again, the terms of trade shock is reversed. So if you think about what risk assets need, risk assets were focused on stagflation. We no longer have stagflation. We might not have an acceleration in global growth because U.S. is now the laggard, but we do have stabilization at the exact same time. What we should also start to see is some acceleration coming from Europe and China to offset the slowdown in the U.S. So this is a great environment, not for U.S. risk assets, but it's a great environment for non-U.S. assets, particularly equities in Asia, which is why this is very bearish for the dollar.
I keep hearing the same thing, Tom. Keep hearing the same thing about ex-US, international. I feel like we've done this a million times. And as for Europe, I just wonder how soon before we start worrying about next winter. And not the one we're working through right now, but the optimism is there for all to see.
But you don't do it in a vacuum. If you assume international goes on weak dollar and you know, robust GDP recovery, can domestic and G3 equity markets also rise with them, if not as much? I think that's left out of the discussion right now.
Mark McCormick at TD Securities. Mark, thank you. Lisa, you and I have talked about this a million times with regards to China, not the demand side, the supply side. Mark touched on it there. I think we're still trying to figure that out. Is this supply side relief or further supply side dislocations?
We don't know. And a lot of people are seeing this right now more as relief and fueling growth more than anything else, including even shrugging off the potential demand for crude and for natural gas.
We've got Max Kettner in about 20 minutes. What do you want to ask him? What's behind this change?
And also, how significantly does this affect the magnitude of the downturn that he's expecting in the second half?
The second half rip that we're expecting, is that now the second half dip, if you expect the rip?
It's a rip and dip.
Is it?
It's a toxic brew.
Rip dip.
I think we need to go to London and see Max and the entire HSBC team there to rip and dip.
Oh, do you? You'd like to make that happen? Is that a night out?
Rip and dip.
Is that a night out?
It's kind of candy.
Plural, he said.
You rip it, dip it.
It's either London or Indiana. We can go to, either one.
I'll take London. So, no offence to Indiana, of course. But,
keep it up.
It was just a home bias there. Just seriously, no offence.
What are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. The problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? The why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
What Fed is indicating is that they are willing to put up with a lot of pain.
The market's going to give the Fed not much credit, frankly.
Whether or not this is a recession, something close to it, something that kind of smells like it but isn't quite is one, whatever it is, we need to go ahead and get it done.
If we tip into a recession, you could have a fair amount of earnings weakness.
The recession is not a question of if, it's a question of when.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Let's get you set up for the trading day. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equity futures not doing much this morning, down about 1/3% on the S&P. A few hours away, TK, from hearing from Chairman Powell.
We're going to hear from him, but are we going to hear from him? I have trouble here, John. With it. He's in Sweden, right? Is it
the Riksbank?
Right, the Riksbank, which is a really important historical bank. But are they going to contain the questions because they're so polite over there to not obnoxious questions like you get from Michael McKee?
We should send Mike McKee every every time Chairman Powell speaks.
Excuse me, sir. I'm from America. I'm clicking.
What do you, can you imagine that, Lisa? If Mike McKee just starts stalking Chairman?
That's a Bramo smile, folks. That was a Bramo Tuesday
waiting
smile
in the corner,
you saw there.
just sort of, skulking around, waiting. You probably wouldn't take the question. If he did take the question, would he answer it? And what kind of question would it be at a time when the market's not listening?
He's got to maintain control. I mean, I don't know what this is. I'm going to call it Whipsaw Tuesday, where we were 3 weeks ago versus the conversation this morning for Global Wall Street. My head is spinning over the shift.
Lisa has touched on the heart of the matter. The chairman and his words carries more weight than the rest of the committee. But have those words lost weight over the last couple of months? Because, Lisa, what he's selling, I'm not sure this market is buying at the moment.
They've looked past it. If you've taken a look at two-year yields in the U.S. over the past couple of months, they've plateaued. They're not going higher, even as you see this resilience, even as you see this optimism that's causing yields in the euro region to increase. If that's the case, the market's saying we're seeing something that you're not, because your rhetoric has not changed. If you're saying 5% is still the low that you potentially could see on the
Should we talk about some of the optimism out there this morning?
Let's, yes.
Goldman Sachs first. So Goldman come out and drop their Eurozone recession call. Morgan Stanley get all bulled up on Chinese assets and growth that maybe pushes close to 6%, at least in the high fives. And we heard from Evercore about an hour ago that they could get 6% plus GDP growth in China. And then Max Kettner, he's going to join us, Lisa, in about 15 minutes' time, suddenly turns more constructive on risk.
In fairness, a lot's happened. This is actually rooted in true events. And if you have a reopening of China that was surprising, and then also fiscal support coming from China, that is surprising. And then weather that is historically warm in Euro. And oh, by the way, there are natural gas tankers floating around that can't find homes. There's that much in terms of oversupply.
You see in the supply shock, I don't know the exact numbers, but at one point you had a 20,000 handle on moving a ship across the Pacific, and it's crashed down to $2,000, just as another indicator of the dynamic shifting.
We're trading the weather. Did you expect that?
I don't.
You've been saying that for months.
I'm not.
Basically bringing a meteorologist.
I'm not trading the weather.
You're not trading the weather?
Nope.
No, why not, Tom?
I just think it's too unpredictable. It's like the Red Sox.
So my issue with the weather story and the crude and the energy story and the gas story in Europe is as follows. This was one winter. What about the next one?
Exactly.
And if you're going to get bulled up on the Eurozone economy, how long for? When do you start worrying about the next one?
People say that they're actually much better set up now for the next winter because they're at 91% stores. And so heading into the summer, it could potentially be a much better setup heading into a time when they cannot access the Russian stores. So some people are even speaking that way, that they're optimistic even on that level. So this is the level of optimism that we're getting.
The heart of the matter, a la Ed Hyman's call, as we spoke to Julian Emmanuel, is do we have disinflation, like the two bouts of disinflation in the late 40s and the early 50s? Really nothing else matters, and everybody's got an opinion on that.
CPI on Thursday.
Huge.
And Trelisa's point in the last hour. The markets and price can change sentiment pretty quickly. And I imagine based on Thursday's print, things could change again. Equity futures right now on the S&P down 1/3%. We're on negative by about 11 or 12 points. In the bond market, yields are higher by about 3 basis points, 356.33. And Tom, euro dollar unchanged right now, but we have reclaimed a 107 handle.
Yeah, there, and I frame it out, Deutsche Bank looking at a 115-ish, and Kitchuk's, I thought, with a really smart note at SocGen saying, X Putin, X the war, right now settled, it should be a 120 stronger euro.
Bremo, that's the euro call after a couple of days of real dollar weakness.
Yeah, honestly, the euro call has been amazing, and the dollar weakness really has pervaded the sentiment that we've gotten pretty much across the board. Today, we've been talking about at the big event, Fed Chair Jay Powell taking part in that panel discussion on central bank independence hosted by the Riksbank in Stockholm. What will he say that actually will matter? At 10:35, we get the ECB Governing Council members Pablo Hernandez de Coz and Klaus Knott, both also speaking at this Riksbank event. Curious to see how they respond to the increase in yields in that region, given how significant the sell-off in bonds have been, given how much people have recalibrated with the optimism, and how much the central bank has to push against that to try to bring core inflation so much lower. And at 1 p.m., we get U.S. selling $40 billion of 3-year notes. A question here of what the demand is going to be like at a time when you have yields that are kind of meandering here. They really haven't gone up as much as the Fed would like to see. Do people start to buy the idea of that the Fed is selling and actually not come in to buy 3-year bonds with yields as low as they have gotten?
Lisa, great work, as always. The day ahead, some bond issues in the mix as well, Tom.
Well, there's been big issuance here. You wonder what CFOs are going to do into this. I mean, you talk about the uncertainty. What do you do with your weighting? Do you expand your weighting of fixed income here? That's a huge debate.
Great lineup this morning. Amy Wu-Silverman joining us now.
Yes.
Derivative strategist, equity strategist over at RBC Capital Markets. Amy, I want to start with your line, and you've got to explain to me what this means. This is setting up for a, quote, boy who cried market. Amy, what does that mean?
Yeah, it's setting up for a boy who cried wolf market. And what I mean by that is, you know, we did kind of a post-mortem of 2022, obviously, just as we did our volatility 2023 outlook. And, you know, my shocking stat is the drawdown on the S&P was 20%, guys. But what did worse was owning the S&P and buying puts. That was actually down about 21%. So essentially, you know, you got the drawdown that you had expected, but you actually did worse hedging, and you actually did better off selling puts and owning calls. Yeah, so very counterintuitive market. And what's happened is people, you know, they're not set up for any sort of downside. They're focused on a upside, up crash. And, you know, that could be a boy who cried wolf market.
What Amy Wu-Silverman said there, folks, is incredibly important. We don't have time to expand on it right now. Look to RBC Capital Markets for that on the failure of hedging. Amy, well, I want to go to the reality, which is tech has underperformed. There's a raging bet that the weighting of tech and SPX will change. You look at the cross moments, the skew, the kurtosis, the variance there is Amazon, Apple, and the rest of the non-profitable tech fail. Tell us about the cross moments if we get a tech underperformance.
Yeah, you know, look, I think this is hugely important, and it's I'm very fixated on this because, you know, I'll steal this stat from Lori Calvestine, our equity strategist, but if you look at a contribution to return analysis, you know, the vast majority of drawdown from the S&P last year was essentially a handful of companies. It was mega cap tech, and sure, the weight is shrinking, but it still has a long way to go. It's still half of the Qs. It's still, you know, at least more than half of XLC and all these weighted ETFs. And as you know, volatility as a component of index weights is correlation plus volatility. So where that correlation goes matters hugely. If tech continues to shrink, that helps the S&P, but it doesn't help these other tech ETFs. And so that relative performance over this year is really, again, going to come down to kind of 6 or 7 names, what they do on earnings, what they do because of rates.
Amy, you used a phrase there, up crash, which I love because it's basically that the risk is that things are going to rally, not crash to the downside. What could drive an up crash in terms of where the leadership would come from in the S&P?
Yeah, you know, so in the same way, Lisa, that we talk about tech shrinkage, essentially the opposite of that. So if we get a tech reflation, a tech reweighting, because again, that makes these indices more correlated, that ramps up your volatility. And essentially that's what investors are positioning for. Even if options investors tell you they're bearish, that is not reflected in the market right now. What they're really concerned about is we get a runaway rally and they haven't participated at all. So, you know, in the next few days, we get, again, kind of better than expected data if earnings comes out better than expected, which is, you know, contrary to what we've seen these last two earnings cycles where you've had massive downside beats. That's when I think, you know, you worry about this up crash, and that's what investors are focused on.
So, Amy, just quickly, what's your favorite trade right now going into earnings season?
You know, the second most well-performing strategy in 2022 was flies. So butterfly strategies, which are essentially very high payout, very low premium strategies. I think those continue to do well when you have events ahead, like earnings. And I like those, again, on kind of the tech ETFs, because that's where the correlation punch is the highest. So something like Qs. Those are the kind of trades I think are attractive right now.
Looking for some big moves. Amy Will-Silverman, thank you.
Is there enough jargon there?
Capital Markets.
She spiked the jargon meter.
I was getting the dictionary out for my derivatives work. Amy Will-Silverman is fantastic. What Amy said there, Tom, I think is so important, though, with regards to what people say versus what they do. And sometimes there's a big spread between what they tell us and what they're actually doing.
Yeah, my quote of the year last year was from Nassim Taleb, who helped invent all the jargon that Will-Silverman studied. And the answer here is these are the subtle movements of whichever probability distribution you believe in. It can be a bell curve like the height of your high school class. It can be traditionally what's called a log normal curve. Taleb focuses on a strange one called the Poisson distribution. Forget about that. The answer is the adults on Wall Street are looking at these nuances. She says with tech, it's an important study.
And to make it super simple, overwhelmingly, the takeaway from that seems to be that investors are positioned for upside risk just in case there's a runaway rally they're not a part of.
And basically led by tech. People did not get rid of their tech bets, and they're basically doubling down that they're going to get a reprisal of the gains that they previously saw.
That's the single most important thing we've heard today, except maybe that stunning 6% China call. Really important, Lisa, that they still have a belief in what Mother Apple will do.
And that's what they're doing, not what they're saying.
We've had some big calls this morning, haven't we? And one of them was from Max Kentner of HSBC. Max was bearish for the whole of 2022. And then we enter 2023. It is January 10th, and he has become constructive. Max Kentner is going to join us next, the Chief Multi-Asset Strategist at HSBC. That conversation on Bloomberg TV and on Bloomberg Radio in about 5 minutes from now. Look out for that conversation. Look out for Chairman Powell. He'll be on in a couple of hours' time, Tom.
We don't have it yet. We may get a positive Bloomberg Financial Conditions Index. 3 weeks ago, that was impossible.
And just to be clear, is that easing or a tightening
that is
of financial
accommodation that
That's
Chairman
an accommodation.
Powell does not want.
Will Chairman Powell push back a little bit later?
He will.
At the Riksbank.
100% certain. Mary Daly told me.
Mary Daly told you. When did she tell you that? In the diner?
Over coffee.
In Jackson Hole, Wyoming?
Yeah.
A number of months ago? Okay.
It wasn't the diner, it was the bar.
It was the bar, okay. All right, just to clarify.
We had
what time was that?
Fernand Branca. That's what
10 a.m.
That's what they drink in San Francisco. Fernand Branca.
Tom was at the bar.
Mary was closing the bar. She goes, we have to have a San Francisco drink, so they pulled out a bottle of Fernand Branca.
Don't start rumors.
And she's my favorite. Full disclosure, Mary Daly's my absolute fave at the Fed.
I thought we didn't do favorites.
I do favorites. Mary Daly has a handle on America like no one.
Mine was Esther George, and now she's leaving.
Yeah, it was Esther George, but she took the dog. She took Transitory with her.
From New York.
Pivot. Pivot was a puppy.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The former engineering chief of FTX is the latest member of Sam Bankman-Fried's inner circle to seek a cooperation deal with prosecutors. Bloomberg's learned that Nishad Singh met with federal attorneys last week. A Singh cooperation deal would leave Bankman-Fried even more isolated. Two former FTX executives are already working with prosecutors. The House voted to repeal billions of dollars of Internal Revenue Service funding that Democrats approved last year. It was the first vote on legislation with Republican Speaker Kevin McCarthy in charge. Now, the measure is not expected to pass once it's sent to the Democratic-controlled Senate. Crypto exchange Coinbase will cut about 950 jobs as it tries to weather a slump in the industry that's lasted more than a year. At the end of December, the company had more than 3,700 workers. Coinbase says the restructuring will be substantially complete by the end of the second quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Wall Street prepares for the latest read on inflation.
There's new optimism about a soft landing.
Inflation may be fading faster than some people thought.
Will headline inflation continue to ease?
It's really about the labor market, wage inflation, and services.
Peak inflation becomes your number 2 concern, and you get into a growth discussion.
Instant reaction on Bloomberg Surveillance.
This is good news for Chairman Powell.
The risk of doing too little, does it still outweigh the risk of doing too much?
How much do we see the worst of it versus just the beginning?
Inflation in Focus, Thursday on Bloomberg.
What Fed is indicating is that they are willing to put up with a lot of pain, and some of the data from the payroll data gives them additional impetus to stay elevated and much longer, and at the risk of significant slowing in the economy. What is important to me is how long they stay there.
That's the big question in 2023. For those of you following the Federal Reserve, that was Vishy Tripatur, the Global Director of Fixed Income Research at Morgan Stanley. Let's get straight to the quote from Max Kettner of HSBC this morning. He makes a shift for 2023. We were staunch bears for much of 2022. Our previous view was that a recession would hit in the first half, and as such, markets would move into classic risk-off mode. We think it no longer holds. The sequencing of a bad first half and a recovery in the second half, it's likely to be reversed. Tom, there's a man for the whole of 2022 who was max underweight equities, and now all of a sudden, starting January 23, makes a shift.
It's a huge shift, and it's a shift from a house that's been very supple and very nimble. All of these houses matter, John. We talk about Morgan Stanley, where they invented fractious debate. HSBC has almost a kinetic energy going back 30 years with Jonathan Anderson in Asia and with others. And HSBC, you know, the people we know, David Bloom used to be there, and Steve Major, and that.
Miss Bloom.
There's almost like a frenzy to it. And Max is the legacy of that.
Don't forget friends of the program.
Yes. Well, I can't remember everybody's name. I mean, you know, there's Lisa.
Love you too.
Grandma's going to start throwing things at you.
She's been throwing
do it on camera. They've removed all objects from my seat. Carry on, Tom.
Let's go on now to an important conversation for Global Wall Street. Mr. Kettner with us, Chief Multi-Asset Strategist at HSBC. Max, John's got a lot of important questions. I'm going to do this simple. How do you dovetail your shift into Steve Major's call for low interest rates?
Yeah, good morning, Tom. I think it's probably the key question is really around the sequencing, right? Not so much where the end result is going to be. I think it's really a sequencing question. And with this really, really pessimistic, these pessimistic outlooks that we got both from the sell side and the buy side in the last couple of months, I think there is a very, very strong consensus, and it is my feeling that it's probably the most concentrated consensus that we had ever since the end of 2017. You may remember back then we had this idea of globally synchronized growth that really then went horribly wrong in 2018. And I think that's probably as much of a concentrated consensus as we've got right now. So therefore, what we're saying is that actually, against the backdrop of such a concentrated consensus, there's simply a lack of downside catalysts, a lack of downside surprises, and therefore the only way is up.
So Max, let's talk about that. So your words, super depressed growth expectations are key. Is there any evidence, Max, here that those growth expectations are captured in the price of markets right now?
Yeah.
And where you're seeing that?
Yeah, I think so. I think when we look at market pricing, so we look at things like equities versus rates, we look at equities versus rates against PMIs, or equities versus fixed income, comparing that against break-evens across sayers. It's not like we're super bullish, right? It's not like I'm saying, growth is going to go through the roof and it's going to be rock and roll. The only thing I'm going to say is, well, it's not going to be a Rocky Horror show, right? So that's the only thing that I'm saying, that basically we're not going to see such extreme pessimism and against the backdrop of such extreme pessimism. You don't need an awful lot of positive surprises, right, to really make risk assets get going a little bit to the upside in the first half of the year. It could change in the second half of the year, right, when the ultimate level of inflation perhaps then is a bit sticky than thought. But, that's something for in 6-9 months' time, not something to fret about right now.
Why do I get the feeling you practiced that line a little bit earlier this morning?
100%.
Sure?
100%.
Definitely. Max, let's finish on this underweight in cash that you did have. Where are you allocating that capital? Where does it go? We've had some big calls this morning on China reopening, Morgan Stanley one of them. On the Eurozone, Goldman dropping its recession call. Where does that cash call go now?
So it's not going into full-on overweight equities yet, right? So we haven't been as crazy as going from max underweight equities to max overweight equities. So we're sort of dipping our toes. We're going into IG credit, into high-yield credit, into emerging market debt, right? So really sort of dipping our toes into risk assets. It's still a preference of value over growth, right, in equities. So we still actually like European equities. We like European equities more than US equities, really like also in EM and in Chinese equities now. So I do think, against the backdrop of Chinese reopening, still a bit of underlying pessimism around Chinese growth, right? So we've just heard a bit of a pretty bold call around China growth early on in your program, right? That's starting to happen now. People are starting to drop recession calls for Europe and for the Eurozone. All that really should be continuing in the next couple of weeks. And as that reappraisal really continues, that should be beneficial for EM equities and for European equities.
So what's on the other side, Max, with the Rocky Horror Show potential that you were talking about for the first half that seems to be pushed out? What are you looking for to determine whether you should go back into your defensive haunch?
Yeah, I think the defensive haunch is probably towards the second half of the year. Once we've seen the negative rate of change in inflation play out, which is really probably going to be happening over the next sort of 4 or 5 months, right? Then we're suddenly going to start seeing, okay, now the negative rate of inflation is in the rear mirror, right? That's the rear view. Now we've played that. Now let's talk about the ultimate level of inflation we're going to stay. Does the Fed have to, does the Fed and other central banks have to keep rates a little bit higher for longer? Do the cuts first have to be priced out? And that then could be leading to perhaps an accident on financial markets or a retightening of financial conditions via higher credit spreads, lower equities. That's then something for the second half of the year. Once that focus shifts from initially now the negative rate of change in inflation, so the delta in inflation, to the ultimate level of inflation where we're going to end up at.
Do you think that the ultimate path for European equities is actually more positive than you previously thought because of this de-emphasis on U.S. tech? Basically, that yes, there might be a downturn, but the optimism around Europe is sustainable.
Yeah, I think so, especially against the expectations, right? Let's remember, there's two things that we do in markets. We trade the rate of change and we trade data versus consensus, right? We don't really care where the data is per se. We care about how it pans out against consensus expectations. And I would argue, 1.5, 2 months ago, there was barely any bull to be found on Europe, right? So that's not long ago. That's just starting now, right? That shift is just starting. So I would really expect there is a bit more, more positive, a bit more of a positive run to go for Europe, both on the credit side, on FX, and on equities.
Wow. Max, great to catch up, buddy. Thanks for jumping on with us. Max Kettner there of HSBC, putting out a note that got a ton of attention in the last couple of hours. Bramo, it is January 10th and we're already getting pushed back against the consensus. What's going on?
I love it. The second week, we get an overhaul of what was established just a couple months ago. It gives you a sense either of how quickly things are moving or how quickly price changes the thesis.
Do you get the feeling that a lot of people are going to follow Max Kettner and HSBC?
100%, because you're feeling it already in the price action. You're feeling it in some of the rationale. And you put together a bullish China call, and you put together some of the bullish European calls, and what do you get?
How different do you think the conversation is, Tom, at 8:31 Eastern Time on Thursday morning when we get CPI? I mean, I've got no idea what that CPI print looks like.
I think it's a lot of ex-ante hot air, MX post. I'm waiting for the data. And as I mentioned last week, retail sales next week will be watched. I mean, the Happy Valley will come to a halt for U.S. retail sales.
We were told it was all about the earnings, and now all of a sudden it's all about China and China reopening. That's become the number one factor.
I would double, to Mike Wilson's credit, I would double barrel them. But on a global basis, the China reopening and to get the scale out above 5%, for them to clear their real estate market with that fiscal input that you talked about would be extraordinary.
Max Kettner spoke to it. That call from Evercore, 6 handle on GDP growth in China.
I mean, they can manufacture it if they want it. That is the theory, and they seem to want it.
When do we start to question that China gets what it wants?
I think when we start to see the actual mobility data.
They get what they want.
The mobility data and the COVID progression.
Okay. Zach Griffiths of Credit Sites, coming up shortly.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, This is a plant that cannot hold on much longer in a changing climate.
Equities a touch softer yesterday, down just a little bit. Chairman Powell coming up later this morning. Going into that, equity futures right now down just a little bit again. We're down 17 on the S&P. Futures softer by 0.4%. It's emotional, Tom.
Yeah, it is.
The Nasdaq 100 down by 6 or 7 tenths of 1%. You think it's vulnerable?
Vulnerable market. Yeah.
And I think this bond market's been vulnerable the last couple of days. We've had a move of 25 basis points at the front end on a 2-year, lower. Today we're trying to bounce up 4 basis points on a 2-year to 424.93. I think Lisa's asking the right question. If Chairman Powell speaks later, will this market listen?
No way. I mean,
have we been processing the Fed speak over the last couple of days?
Honestly, is this a market that hears what the Fed is saying, which is that we're going to be hawkish? I'm not a pivot guy. We're going to get to 5.25% and hold it for a very long time. Is this market recognizing
Responding to the data, isn't it? Softer wages, survey data sub 50, and just saying, I don't think you're right.
Yeah, well, maybe they're right. I don't know. We'll have to see, honestly.
We will. We'll have to see on the euro story as well. Euro dollar shaping up as follows this morning. 107 handle, holding on to it, unchanged on the session on that currency pair, 107.30. If you had a look at the FX market in yesterday's session, pretty much everything stronger against the US dollar in G10, pretty much everything stronger against the US dollar, Tom, in Asia. The Korean won absolutely flying. EM equities back in a bull market. Everyone bulled up on China reopening and seemingly a little bit of optimism around Europe too, with Goldman dropping its recession call.
When's the last time we talked about Korea? Korea is a unique in that it's considered the most American of the economies over there, the most open, the most fluid on a philosophical basis, the most lock-in. And the answer is the Kospi. Their equity market has been traditionally the roulette wheel of Asia. That's where you get beta, that's where you get play. And the Korean won is very supple, not only dollar won, but the cross rates to Korea and the Pacific Rim.
Well, let's take dollar one. Dollar one in yesterday's session, Lisa, lowest since last June. So some one strength really kicking back in and just dollar weakness all over the place.
Especially with the reopening of China and suddenly this feeling that perhaps the rest of the world is going to fare better. I'm looking at some specific stocks that are moving just in terms of the zombie roll-up that Tom talks about. Here's a zombie roll-up in the healthcare industry that people are looking for, although I don't want to call this acquisition target necessarily a zombie by any means, but you are seeing consolidation. Oak Street Health shares surging more than 35%. CVS is exploring an acquisition of this. And basically, this again goes to consolidation of among the strongest players that we're potentially going to see, pretty broad-based. HP Enterprise, interesting to see weakness across the tech space, down 2%. And this comes after the Taiwan semiconductor space actually posted a disappointing profit. This, to me, fascinating, ongoing weakness and projections from the tech sector amid a lot of concern about what could potentially happen. And Bed Bath & Beyond, those shares, I mean,
why are they in the news today? What's the so what?
They're going to report earnings, and they're going to have a call at 8:30 a.m. They're actually fascinating as some of the details come out about what happened with them. Basically, their suppliers went on strike. They didn't believe that they were going to be able to get them their money back, so they increased the credit terms. So Bed Bath & Beyond, if you're going in and seeing empty shelves, it's because they couldn't get the supplies, which I find really interesting.
I'm glad you do this quickly, Lisa. Oak Street Health, I wasn't aware of. You know, you go to a weighted average cost of capital, it's sort of responsible and grown up in that, and they've gone from 60 to 20. The shares are cratered along with other non-profitable companies. I'm looking at the income statement, and the big difference with Oak Street Health is it's a whole new world after all for them. Money costs something, and they're looking at negative EBITDA margins, negative net income. Revenue growth is snappy, no question about that. What do? You find somebody to help you, and that's what we've got this morning.
Have you ever watched Undercover Boss? You ever watched that program?
What is it?
Undercover Boss. Have you ever watched that program?
Undercover Boss?
I'd like to see Tom go and do Undercover Boss, but as the boss of Bed Bath & Beyond or something like that.
That would be very
Wouldn't that
interesting.
be cool?
That would be very
I
cool.
think 20 years ago, given the free money, undercover boss would have said,
I don't think he could ever
"Shut
go
it
undercover."
down."
That's my question. I just wonder how they disguise him.
He'd wear
and what
sunglasses.
they disguise him as.
Yeah, exactly. I mean, I don't know. if
John from York was talking about me being an undercover boss for Bloomberg TV and radio.
Oh, really?
Yeah.
What would you be disguised as?
And they said, "No, I don't think so."
Would you like to put my microphone on?
No,
Okay.
Just,
Is that what you do? Sort of get the mics ready and
yeah, get the
work the studio floor?
Yeah,
You'd be good at
fix
that.
it up.
That was my first job. I was terrible at it.
Really, you did
I was
that?
shocking at it, yeah. They said, get on TV. Not
do a
doing
good
that.
job.
And that story's pretty close to the
We're
truth,
going
to
to
be honest
continue
with you.
now and save ourselves. Zachary Griffiths joins us, senior fixed income strategist at Credit Suisse. And so what's so important here is he parses out in a very short space the segments of fixed income. Lisa Abramowitz knows this, and Lisa, he leads with distress is the place to be.
Yeah, the place to be, not to avoid, the place to go into. And this is the shift that we've been seeing pretty consistently, Zach. Given the fact that we're looking at a situation of a potential downturn and central banks that are determined to stymie growth, why are you getting long high-yield bonds?
Yields look too good to be short, and when we look at the scenarios that we expect for 2023 and kind of balancing those out, we think that the potential for returns in the 12% area really make high yield an attractive place to be. And we're also more optimistic on the economic front, which is very important for our call for high yield as well. We think that we are able to avoid a recession in 2023. We have growth fall to well below potential in the 0 to 1% range, but we don't have that recession that's driven by our Fed funds call, which is more dovish than the market expects. We think you're really seeing a turn in inflation over the past couple of months, which is set to continue. And the Fed has acknowledged this. Now, I recognize that the messaging certainly this week has been more hawkish. We think they're going to remain hawkish, at least on a forward guidance perspective, until they're fairly certain that inflation is coming sustainably lower. We think that's coming sooner than the market expects at this point.
A couple of years ago, Zach, people were saying that if the central banks decided to abandon some of their low-rate policies, it would be Armageddon in credit space. You'd end up with defaults skyrocketing. You'd end up with companies unable to finance themselves after existing on free money for so long. Why are you saying that that entire scenario is just wildly wrong and that actually high rates is going to lead to a really good scenario for bond investors?
It's been incredible how much the market, or how well the market has held up so far, I'd say, with just such an incredible move. If you look at the move in real rates, it's been just so substantial. And I think, going into 2022, many thought that the market, whether it be credit or equities, wouldn't be able to handle it. Now, 2022 is certainly an awful year from a total return perspective, really across asset classes. But we think the balance of risks are a little bit more balanced than what the market is suggesting at this point. And so when you think about where yields are, just how good economic fundamentals are and fundamentals for companies coming into 2023, we think that yield risk perspective really favors going into high yield credit. And we think that these credits can withstand higher yields at least throughout this year.
Tell me about energy and credit. And energy and high yield has always been the challenge. I think energy was doing well at $100, $120 Brent crude. We're not there now. Is energy challenged as they refi high yield?
We have a bit more of a balanced outlook for energy in the high yield space. We had been more constructive throughout 2022. I think as you have seen energy prices come down, it's going to be less of a tailwind for the energy market. So we are market perform on high yield energy in 2023, and that's a big factor, Tom. So we think that it could hold up decently well in this market, as we think that economic growth remains at least positive throughout this year, but we don't have the full-throated constructive outlook that we had in 2022.
Zach, I want to go all Common and Tversky with you and talk about regret. 12 months from now, if we get a bounce in the annihilated Bloomberg Total Return Index, price up, yield down, are we going to regret missing that? What's the magnitude of the bounce we could get in the Total Return Index?
We think it could be substantial. Now, we are expecting yields to remain elevated throughout 2023. We think the 10-year Treasury yield is heading back to 4%. And so I think we're in more of a buy-the-dip territory from a purely duration perspective. And it's going to be interesting to see what happens with CPI this week. That's certainly a huge figure going into the FOMC meeting at the end of this month. We're expecting just a 25 basis point rate hike and think the Fed might even be able to pause from there. Now, the timing perspective of that is what's going to be very difficult. We've been looking at different inflation scenarios and think it could be coming back toward 2% by the end of 2023. We think the Fed has recognized that, but messaging so far has been quite hawkish this week. It'll be interesting to hear from Chairman Powell later today.
Zach, just to be clear here, just to clarify what you just said, coming back towards 2 at the end of 23, does that mean they think it's going back towards 2 by the end of 23, or you think we land at 2 by the end of 23?
I guess both, John. I think that the Fed has recognized in several adjustments to the policy statement. I'd say the FOMC minutes recognize that the risks are more balanced than they have been for quite some time. And so we think that the Fed is looking at inflation on a forward basis, and you're really starting to see that goods disinflation now. And we think the services disinflation, especially from shelter costs, is coming in the second half of this year. So as they calibrate policy over the next couple of months, we think those two factors are going to be crucial, and they recognize those, and that's going to be what emerges over the next couple of months with a policy pause, not a pivot.
Well, there's a call. Zach Griffiths there of Credit Size. Zach, that was great. Thank you, buddy. Thank you very much. I mean, we joke about everyone being consensus, but wow, we've had some calls this morning. Another 25 basis point hike and then a pause. That's what Zach's talking about, convinced of getting back to 2 maybe by the end of this year.
Rapid disinflation that actually is sticky. And how does that fit into the labor market story that we've been hearing from economist after economist with a structurally tight labor market? This is sort of the conflict that's inherent in a lot of the market calls.
Alan Blinder writing on this in the Wall Street Journal, and Olivier Blanchard, folks, will join us in an hour. Professor Blanchard with my essay of the year, no question about that, a new book out. And, you know, Olivier Blanchard says, stop sweating this 2% silliness. Just bring it down to what, 5 to 4 to 3 at imposing 3%.
They're going to change the target. Is it too early to discuss
that? Just the fixation with Powell today will be 2%, 2%, 2%.
What's interesting about this conversation today is it is on central bank independence. That's kind of interesting, right? At a time where they're saying,
particularly the heritage of the Riksbank.
At a time when they're saying unemployment needs to go up, and I'm sure many people, elected officials, wouldn't like unemployment to go up. I mean, this is they would say that this is why we need independence, because we've got to make these hard decisions that politicians wouldn't make to make sure that inflation is low. And I think a lot of people would respond and say, well, what happened last year, the year before?
I wonder, though, with Fed credibility, it's one thing to talk about independence. People don't believe them. People don't believe that they're going to stick to their guns. People don't believe that they're going to go against what an economy could potentially do in terms of higher unemployment.
Can I segue?
I don't know what you asked.
I mean, honestly,
if a different nation or a different royal family decided to buy the Boston Red Sox or the Los Angeles Dodgers, this country would be apoplectic. Explain the culture that World Cup Qatar and the family there can look at, I believe it's Manchester United, Liverpool, or dare I say even the Spurs.
Yeah, it's attracting a lot of capital, the Premier League is.
Am I right? Newcastle was taken out by a Saudi portion?
Yeah.
Is it a Middle East takeover of your sport?
I think there's an American takeover in the mix as well.
I'm just doing this because I want to go see Fulham and Tottenham.
Fulham.
And, I thought it was Fulham.
You're looking for a full hand.
Are you trying to come up with a reason to go to London?
You got that right. I don't give a damn.
You sniffed it out.
Mr. Levy, I don't care about the future of the Tots. I just want to go see you in Fulham.
Fulham.
Oh, excuse me.
He wants a full hand.
Oh, God, you're kidding me.
Having too much fun, keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Well, the UK's attempt to send the first satellites into orbits from its own soil has failed. A rocket launch from a Virgin Orbit Boeing 747 that took off from England malfunctioned. Now, that led to the loss of its payload of 9 satellites. The jumbo jet and its crew did return safely. After years of drought, California is in a long flood fight. Since the end of December, waves of storms have rolled in off the Pacific Ocean. They've killed at least 14 people, closed highways, and forced residents to flee. On Monday, there was an evacuation order for the town of Montecito, home to Oprah Winfrey, Prince Harry, and Ellen DeGeneres. China is striking back at countries for imposing COVID-related curbs on Chinese travelers. Beijing has suspended issuing some visas for South Korea and Japan. It's China's first attempt at retaliation after a number of nations implemented testing requirements for travelers from the country. BMW outsold rival Mercedes-Benz for the second year in a row. Worldwide deliveries of BMW branded cars fell 5% to 2.1 million last year. Meanwhile, Mercedes shipments were down 1% to a little more than 2 million. BMW did a better job with dealing with supply chain issues that hampered auto production. And in college football, Georgia has won its second national championship in a row. The Bulldogs pounded TCU 65-7 in a game that was more or less over before halftime. Georgia quarterback Stetson Bennett threw for 2 touchdowns and ran for 2 others. I'm Lisa Mateo. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Whether or not this is a recession, something close to it, something that kind of smells like it but isn't quite is one, whatever it is, we need to go ahead and get it done. We need to go ahead and get it started from an equity market perspective. Markets really can't handle that. Will we, won't we, will we, won't we? They just want to know, they just want to rip off the Band-Aid and get back to business.
Clear the decks, rip off the Band-Aid. That's the message from Lori Calvasina, the head of US equity strategy at RBC Capital Markets. Will we get that this earnings season? JP Morgan reporting numbers this coming Friday. Before we get there, it's CPI on Thursday and Chairman Powell a little bit later this morning, about an hour and 15 minutes away. Going into it, equities turn lower by 0.7% on the NASDAQ. Tom on the S&P 500 futures here softer by 0.5%, and crude just about holding on to $75 a barrel on WTI, on a session at least, up by 0.5%.
Interesting day to say the least, and wrapped around all of this has been oil. John, would you say with a lift here in the last 2 weeks or so, getting up about to start to 80, 81 on Brent crude? We're sort of there now.
It was an odd start to the year, let's put it that way, with regards to the commodity market. But certainly the calls are coming through, Tom, and a more optimistic view, again, off the back of a China reopening story.
We'll reframe and reset now. We do this with Ellen Wald, senior fellow at the Atlantic Council. The rarest thing in the story, and that means she's read Daniel Yergin, the prize cover to cover twice. That's what qualifies her to be an oil historian. Ellen Wald, I want to go to your acclaimed Saudi Inc., your knowledge of the royal family of Saudi Arabia. They're in the news. They're in the news on geopolitics. They're in the news with Mr. Putin. Maybe they're in the news with President Biden as well. What are you studying about the Saudi family early 2023?
Yeah, I think that the question for Saudi Arabia for really this year is, are we going to see any big shakeups in terms of the line of succession? Are we going to see MBS move into an official position of power? I'd say I think that they're probably going to keep things status quo for this year, unless obviously there's some kind of health crisis. But that's really probably the biggest source of instability that could face them now. Oil prices are generally not really a source of instability for them.
How do they fit into the Levant, from Erdogan and all his desires up in Turkey over to in Iran, which is, falling apart is maybe too harsh. But how do they want to be a regional player with their marginal oil power?
They definitely want to be a regional player in the biggest sense. I think for a long time, they were content to really be kind of the source of money and also the source of religious authority, and to kind of play that role, not so much in the kind of big, flashy media sense, but really just as the kind of the soft power, both religious and in terms of money. But now I do think we're moving into a phase where they really want to be out there as, the guys doing the big business deals, the source of the biggest and the best and the flashiest. And I think that that's really a new look for them. I do think that the younger generation, that this resonates with them, but there are definitely a lot of people in Saudi Arabia, older or more conservative types, who are much more hesitant to really see themselves, making the big splashy media pages, and they're not very comfortable with that.
Let's talk about where those big deals might come from, and the China reopening that we've been wondering about for so long in terms of its influence over crude markets. Why is there not more optimism or perhaps pessimism, depending on which side of this you're on, that China's reopening will cause a huge increase in demand and push up the price that we're seeing in crude markets?
Yeah, this is a really good question, and I think it's definitely the number one question on the minds of oil traders and kind of everyone who's wondering about oil prices right now is, when are we going to see that big jump, that big surge in Chinese demand from the reopening? And I actually am kind of thinking that we may not see a huge jump or a huge surge. It may be more like a slow kind of a slow push upwards, a slow curve upwards, because I'm not sure China's going to react the same way that Western economies have. We may see a lot more hesitancy on the part of some parts of the Chinese population to jump back into flying and driving and going around. So I wonder if we're not going to see that, though. The real question is, who would know? And I think that the Saudis would probably be the first to know what's going to happen with Chinese oil demand, because they've got oil deals from here to there with Chinese refineries. They're a huge source of oil. Yes, so is Russia, but Saudi Arabia's got the long-term deals, and so I would say that they would probably be the first to know from the Chinese government when they think that oil demand is going to start going up. And we may see some movement in terms of the price that Saudi Arabia is selling oil to China, or the amount that they're selling to China, moving before that surge upwards.
If there isn't a surge upwards in demand from China's reopening, where does that send oil prices? Do you see them even going lower if this warm weather holds?
Well, I think the warm weather is definitely helpful, but I do think that once we hit summertime, that warm weather will cause a surge in oil demand. And I think that if we don't get a surge upwards, but we do see kind of a slow trickle upwards, that all of a sudden a day will come when we're like, wow, oil demand is huge now, or we've finally hit that that mark, but no one really necessarily saw that giant jump. That could change, though. I mean, the Chinese government has its ways of kind of compelling people to do what they want, and they may kind of push the population in that direction.
Now, let's go all Excel spreadsheet. Where's oil going to be in a year? Do you buy the bulls that talk of 100, 120 a barrel? Do you buy the story?
I don't make forecasts because I
it's
think
TV. Nobody's listening. Come on, Ellen. Don't go to pennies. Just give us a dollar level on Brent.
That's the real issue.
I'll say that 120 is definitely a possibility, though I don't see that as a sustainable number.
That's how you do it.
See how she nailed that?
You say something's possible.
That was an interview for. I think that Jeff Curry needs to hire her. That's all there is to it.
Ellen Wald. Ellen, fantastic. Thank you. Ellen Wald there of the Atlantic Council. What do we always say? I said it yesterday. How do you make a fool out of someone? You ask them to predict the oil price 12
Yes,
months out.
or when. She was the amateur. She said a year out. Yeah.
So hard. It's so hard. It's ridiculous. I mean, based on what's happening in China, who knows what that's going to look like by
It's
year
like
end.
predicting what inflation will be Thursday.
I wonder if people are going to have an outsized reaction to whether or not Saudi Arabia or OPEC Plus decides to cut production or to increase production, to look for the tea leaves of their knowledge of what China's plans are. Because if, as Ellen Wald was talking about, there are discussions about what China is really desiring in terms of seeing mobility among residents, that could change the game.
Where did she go recently?
He's been all over the place.
Went to Riyadh,
yeah,
didn't he?
Yeah, he went to Riyadh, but he's also been,
You know, this goes back to Robert Lacey and the great work by Ellen Wald and Dr. Jurgen and others. What's irrefutable is a generational shift in Saudi Arabia. There's no question about that. And that, you know.
And that's come with some tension.
Huge.
Riyadh, DC. That's come with some real tension.
Yeah.
Over the last 12 months. Have we resolved any of that? Because it was pretty fiery going towards year end.
I just don't have the knowledge base on it. I would say it continues into this year is where I would sit, and particularly the relationship with the White House.
Do you remember that odd moment going into that OPEC Plus meeting? And the Saudis came out the other side and basically accused the administration of asking for a delay until after the midterms?
There was not exactly a meeting of
pretty
the
blunt
minds.
stuff, right?
This wasn't exactly a fist bump that got any particular leverage.
No, and I wonder how that shapes up a little bit later this year. What's happening with refilling the SPR? That's turning out to be more difficult than expected, right?
People are saying, or the administration signaled that they would start refilling it by February of next year. And potentially, if they do refill it without moving the markets, it'll be considered a win for them because they basically sold high and bought low. But there's a question of whether they can refill it enough and what that does to the pricing, right? I don't understand the dynamic and how much that could potentially push prices up if they're buying.
Who do they buy the oil from?
So here we go. We've got the administration are basically saying we buy around 70. Is that right?
Right.
So we've got this floor of 70 with the administration basically saying we're ready to buy.
Right.
And then you've got China reopening. So what's the floor for crude this year?
I mean, you've got to imagine that it's got to be 70, if not
right, that's
more
what
than that, right?
I'm asking, I'm trying to work it out.
But the question is, does it go to 75, 78? Do they start kicking it up a little bit as they try to prepare? Does it get away from them? Do they have to come in? All great questions. If they plan to start refilling it in February, do they move away if it isn't that 70 handle?
$80 right now, there and thereabouts on Brent, 79.91. About an hour and 5 minutes from now, you hear from Chairman Powell. Bit of optimism out there this morning. In fact, I'd say a ton of optimism around the Europe story. Guess who's going to weigh in? James Athey of Aberdeen, Tom, Investment Director. Your favourite firm. How do you pronounce that?
It's like the tots. The tots would be the.
I can't believe that they changed their branding of Aberdeen.
Would be
They need to get
They
some
dropped the vowels, and I thought it was a joke the morning they did it.
Yes, we all did.
And they've committed to it.
I'm in that camp.
We're just like you,
James Athey's a good sport. I mean, he'll go along with it. But every time I ask anyone at Aberdeen, you know, is it changing anytime? They just look at me like, John, just shut up.
You mention that one more time, I walk out.
You don't want to talk about it. James Athey.
You're one of the most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's I mean, it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, you know, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, so the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, I mean, making things is important important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I mean, I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, you know, proximity is going to be key.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What we're in for is an awful lot of choppy trading as the market reacts to the ebb and flow of this very volatile news flow.
The bond market has been so choppy, so volatile now for really the past 6 months.
We have to get used to an inverted curve all this year, in our view.
A sustained, deep yield curve inversion is not a soft landing story.
To me, a soft landing is a landing you can walk away from, and I think the economy is strong enough right now, at least it looks like that it'll do so.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. Neela Richardson out front of the optimism today. And John, it is Optimistic Tuesday.
Is that what you're calling it?
I'm calling it Optimistic Tuesday on the way to Inflation Thursday.
Let's see if that optimism holds going into Thursday morning at 8:31 Eastern Time, 60 seconds after that print. But sure, so far, so good. Goldman says no recession in the Eurozone.
Euro moves.
They drop their call. Morgan Stanley comes out and says we're underestimating the impact, the positive impact of China reopening. Good news. Max Kettner, about an hour ago on this program of HSBC, has changed his view. He was downbeat on risk assets last year. He's upbeat.
Right. Let's go to the thermometer, Lisa, very quickly here. The spread market, the spread market is the thermometer for equity participants. Does it suggest an optimism?
Yes, it does. It's been ripping. If you take a look at high-yield bond spreads, they're at the lowest levels going back 3 months. I mean, basically, you saw a huge inflow into the most speculative of credit, of corporate credit, because people believe that companies will, to use somebody's term, adapt and adjust and move forward. And this is the issue, right? It's sort of counterintuitive because everyone was calling for Armageddon when rates rose.
I mean, and it's about earnings. Mike Wilson made it very clear he's earnings-centric, but so many others, John, combine that with the inflation call globally.
He thinks the earnings are going to be dreadful, and there could be as much as 20% downside plus in this equity market. Look, Tom, we came into the year, and I think it was the managing director of the IMF, Kristalina Georgieva, that said the global economy is in for tough times. High-yield spreads are tighter, EM's ripped, the dollar's weaker. That doesn't scream tough times at the moment, does it?
In this hour, Olivier Blanchard with my essay of 2022. He will join us, thrilled by that, with the Peterson Institute. And John, this is the whole debate of if we get disinflation, what does it do to Mike Wilson's world if we don't get to the vaunted 2%?
Well, Lisa's good on that, and it becomes a margin story, doesn't it, Lisa, pretty quickly?
That's exactly where I wanted to go. You can read my mind. Lululemon. And this, to me, is really the question, that even if you get disinflation, even if you get this positive economic data, what does this say about consumers perhaps pushing back on the margins against prices going up? And I really don't think that this has been talked about enough. The Small Business Optimism Index, I'll get it out. Small Business Optimism coming out at the softest reading, the second softest reading going back to 2013. It surprised to the downside. So there isn't necessarily optimism everywhere.
Okay, I want to digress here. We're going to get this out of the way and check the box. Crypto will have much more on this afternoon. John, Dana Bass kills it with the idea of the newest vogue, which I really don't understand, is Chat GPT, which is artificial intelligence so Lisa's kids can do their homework.
I think it's amazing.
I think I got that right.
We'll talk about that in a moment. So let's talk about the news, and then we can talk about the homework issue. So Microsoft, according to people familiar with the matter, is interested in maybe investing as much as $10 billion into OpenAI.
In an idea that came out 90 days ago.
That's the creator of this bot. We understand from Semaphore, I think in the last week or so, that they could be valuing OpenAI maybe at as much as $29 billion. Homework question's fascinating because none of us had access to the internet in quite the same way the kids do these days.
We call it Cliff Notes, John,
to go
in
on
America.
there and get to cheat, basically. Bremo, now I just wonder, can you go on and get a first draft from Chat GPT and then just edit it and then send it in?
So theoretically, this has been a discussion at home, and theoretically, this has been an issue.
And can you tell us how it's working out in reality?
The way it's working out, it's not quite good enough for high school level. At this point, it's not quite good enough to pass as the kids work. But they're testing it out every day, so maybe it'll get there pretty quickly. And you have to wonder, what is the consequence
Grandma with the report there. The fossils of us are going to look here. A kid out on Twitter had this, and I thought it was absolutely great. You go to this silliness, artificial intelligence homework, and you can do the history of John Farrow's London. According to Dr. Seuss, you put that in, and John, you get once upon a time in a land across the sea, there was a city called London, as grand as can be. It started as a small town by the River Thames, so wide, but it quickly grew and flourished with buildings tall and wide.
You missed your calling.
I mean, come on.
You should read
this up. I think it's a great idea, and I'm glad your kids are cheating through school on this.
They're not.
John,
They're not getting away with it yet.
Well, no, it's my kids that are cheating through school. John, $10 billion for the latest Vogue idea?
Well, think about how much money it could save, potentially, and how many people it could replace. Sam Rowe asked this question recently. Do you remember Sam, Business Insider, then Yahoo
Do I
Finance?
remember Sam Rowe?
Sam
the only reason I got through CFA was Sam Rowe.
Sam Rowe was just absolutely awesome. And he asked this question on Twitter. What would your editor do if you were a reporter and you'd been filing first drafts that had been authored by ChatGPT, and they were pretty good drafts and they needed some corrections, but no more than the average editor would have to correct on any given day? What would they do?
They would fire the person and just use ChatGPT. I mean, this is the question, is at what point do you need the middleman? I mean, this is one of the search engines that you're dealing with Google. They're actually trying to use this kind of ChatGPT to get better results, but at what point does this replace
I mean, it's a new debate for Wikipedia, or the debate of Google search and all that. It's technology overrunning the methods we knew.
The human touch, Tom.
It's a human touch.
Can't lose the human touch.
It's just a sensitive.
In some areas you can.
So emotional about it.
You know, there was almost like a Peter Gabriel moment there.
You know, we're going to have a producer moment when one day a producer just goes on ChatGPT and just says, screw it.
See these guys. Let's do this. Let's do a mini data check. John, I'm looking at massive accommodation in the Chairman Powell's comments here in an hour.
The Chairman Powell, about 54 minutes away. We'll see if he pushes back. It's a forum on central bank independence with the Riksbank, which I believe is the world's oldest central bank, Tom. And it's an opportunity in the Q&A. If he wants to push back, he can, but we'll see what the questions are. Futures on the S&P down about 0.5% going into this, and Tom, yields higher by 3 basis points, 356.51 on a 10-year.
James Athey joins us, always adding value with Aberdeen. Thrilled he could be with us today. James Athey, are we in a disinflationary trend?
Good grief, Tom. I'm so glad you didn't ask me about ChatGPT. I'm pretty sure, based on that little poem, that it will be replacing me pretty soon. Yeah, Tom, I do think we are in a cyclical disinflation. I think the base effects are such a huge hurdle for the inflationistas to clear in the next 6 months. Even if we have an oil bounce from here, you're still going to have pretty negative base effects for a while. And I think, therefore, we're going to see headline disinflation. If we don't get another rise in commodity prices, I think that disinflation in the second half of the year will kind of filter through into core, and the picture will look very, very different. But, you guys have already been discussing the China reopening. I think that's definitely the biggest and most obvious risk to my cyclical disinflation view. Secular inflation, I think there are some interesting arguments. I don't claim to have the answer there at all. For me, that's a question of levels and changes. Does deglobalization mean a higher price level, a kind of one-off move, or is that a ongoing sort of multi-year, decadal inflationary force? I'm not quite sure.
James, let's get to where this leaves Europe. You know the call from Goldman from a little bit earlier this morning. We no longer look for a Eurozone recession, reflecting better growth momentum, sharply lower natural gas prices, and earlier China reopening. Would you go along with that based on the data you've seen so far?
I mean, you can understand how they get there. Obviously, the Goldman guys are much more bullish just in general. They don't have a US recession. Their view is that financial conditions operate a lot more immediately, I think, than conventional wisdom. So they think already we've passed the sort of peak impact of the Fed tightening, and therefore the jobs market has survived, and they're quite bullish. I'm not convinced by that argument at all. I think the delta that they've noted, low gas prices, is a relief for governments. It's a relief for government funding. It should be a bit of a relief for rates. And obviously China reopening is definitely a potential boon to German manufacturing and exporters across the region. I'm not convinced that allows them to avoid recession. I mean, if we do end up in a place where Goldman's is right and all of these economies avoid recession, even with this mammoth monetary tightening that we've seen, it really does raise some significant questions about what central banks have been fretting about over the last 10 years with respect to the damaging impact of tighter monetary policy, I have to say.
So are you going in the opposite direction? Are you hoarding cash? Are you moving away from risk in order to counterbalance some of the recent optimism?
I mean, Lisa, you and I are probably more biased to be on the miserable side than the others.
May we quote you on that?
I think it's interesting that I found my way onto the show on Optimism Tuesday because I'm not really known as an optimist. Now, I mean, I wouldn't have been cyclically positioned anyway. I think we're seeing lots of dead cat bounces, lots of bear market rallies, lots of Pavlovian responses, right? The market has just become so accustomed to the Fed ringing the bell, everybody salivates and buys risk assets. I think this is a different world. I think there's more of a secular decline in valuation multiples, particularly in the US coming. And more to the point, I think we are headed for a recession. And I think, like Mike Wilson, I do very similar maths. I get to a kind of similar number, maybe. I think earnings of around $200 and an average PE of, say, 14 or 15, and you get to 2,700, 300-ish, 3,000-ish for the S&P.
Well, James, that's the equity core in the US. How would you characterize the move in EM? Bull market up 20% since October. It's ripped.
Yeah, obviously there's a couple of things there. One, obviously the dollar's been weak, and that's generally good for EM. The other is that actually in a lot of the kind of bigger emerging markets, we saw a much more credible response to the pandemic, both on the monetary and the fiscal side. You take an economy like Mexico, and you can't really see any deviation in their current account balance as a percentage of GDP, unlike the US, where it obviously blew out and has come back aggressively. And the monetary response was quite rapid, and it was quite orthodox. And so a lot of those central banks are more ahead of the curve. I think, therefore, there's a lot more in the price, shall we say. Equities look cheaper relative to the economic outlook. I still wouldn't be piling in myself here. I like EM local rates, to be honest. I think that's a more attractive story for me.
James Athey of Aberdeen. James, thank you. You should do a podcast with Bramo. Transatlantic. Wouldn't that be cool?
Yeah, just
what would you call it?
Simple, miserable.
Miserable.
Yeah. Athey and Bramo, miserable. I mean, that's what I learned out of that.
Yeah, I'm sure so many people were listening. I was actually thinking, what would be my response? And I went to ChatGPT to try to create one. But
what does it say?
It's at capacity right now, so I'm not able to create a response. I'm just sitting here in my miserable hovel.
Have you ever skied Piani di Bobbio near Lake Como?
No.
I mean, with the weather in Europe, the ski resorts are really
go skiing?
No,
he snowboards.
I used to. Used to is the operative. Hard boot snowboard.
Oh,
yeah.
Didn't know that.
Did you do jumps?
Is it another life?
Half pipe?
No, not half pipe.
Is one of us going
down
skiing?
the mountain.
Is one of us going skiing?
No, is one of us going skiing? Really?
One of us might.
Not me. I'm
ChatGPT.
No, not skiing.
not scared.
Coming up, 8:30 Eastern Time.
I like it, though. I mean, you know, Clusters is better.
Nationwide.
Clusters is better.
Are you doing that?
I like it there. You know, Clusters is, you know, it's a distance. I'd probably stay in there.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The former engineering chief of FTX is the latest member of Sam Bankman-Fried's inner circle to seek a cooperation deal with prosecutors. Bloomberg's learned that Nishad Singh met with federal attorneys last week. Two former FTX executives are already working with prosecutors. The House voted to repeal billions of dollars of Internal Revenue Service funding that Democrats approved last year. It was the first vote on legislation with Republican Speaker Kevin McCarthy in charge. The measure is not expected to pass once it's sent to the Democratic-controlled Senate. Attorneys for President Biden discovered classified documents while packing up the Washington office he used after serving as vice president. The White House says the materials were turned over to the National Archives. The Justice Department is reviewing the matter. Former President Trump is under investigation for his handling of classified materials at his Florida estate. Crypto exchange Coinbase will cut about 950 jobs as it tries to weather a slump in the industry that's lasted for more than a year. At the end of December, the company had more than 3,700 workers. Coinbase says a restructuring will be substantially complete by the end of the second quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Wall Street prepares for the latest read on inflation.
There's new optimism about a soft landing.
Inflation may be fading faster than some people thought.
Will headline inflation continue to ease?
It's really about the labor market, wage inflation, and services.
Peak inflation becomes your number 2 concern, and you get into a growth discussion.
Instant reaction on Bloomberg Surveillance.
This is good news for Chairman Powell.
The risk of doing too little, does it still outweigh the risk of doing too much?
How much do we see the worst of it versus just the beginning?
Inflation in Focus, Thursday on Bloomberg.
Trading partners that are like us, Canada, U.S., and Mexico, who do enormous trade volumes. I mean, I would say that this is one of the most successful trading relationships in the world. The three countries have been trading together for 30 years. If I look at 2021's trade volumes, we've done nearly $2 trillion every single day. It's $4 billion of trade. So these are significant numbers in trade between the three countries.
That was the Canadian Trade Minister speaking to Bloomberg's Anne-Marie Emery Jordan as the three leaders get together in Mexico City from Canada, from the United States, and from Mexico as well. The three of them set to announce a deal on climate goals, including to Dow Jones reporting just moments ago. We'll pick up on that with AMH in just a moment. We are about 40 minutes or so away from hearing from Chairman Powell. Going into all of that, equity futures are slightly softer by 0.5%. Yield to higher by 4 basis points on a 10-year, 357.44. As Mike McKee said to me yesterday, Chairman Powell talks sort of, because it's on central bank independence, and really what we're waiting for is the Q&A and hoping that someone asks a couple of pointed questions, Tom, about policy in the United States.
I don't know what we're going to see on the question line, but what we're going to see is a wait for Thursday. I would suggest, John, every day since the jobs report, every hour, that inflation report becomes more germane. Let's break that apart. Is it core or top line that matters? I would suggest both.
And then we get straight into earnings. We'll be knee-deep in earnings season by the time we get to Friday morning.
Let's assume that's negative. Let's assume there's a tinge there that's
based on Jeffries. Did you see the Jeffries numbers? Yes.
Better than expected.
Still pretty dreadful, though, weren't they?
Still pretty dreadful, but is it the absolute number, or is it the bar that they've got to cross, right? How much of the disappointment has already been baked in to what people have seen?
Well, for markets, as you know, Lisa, Tom, it's always relative to expectations, so we'll see.
Yeah, we'll have to see. I mean, there's just no question about it. Let's jump over now to Mexico City. Emery Jordan traveling with the President of the United States. She comes to us in front of that iconic statue of Mexico City. It is over her left shoulder on radio, the Angel of Independence, and we speak to the Angel of Independence this morning on what's going on in Washington. Anne-Marie, the clumsiness of the Republicans and what Speaker McCarthy agreed to, do we clear that mystery up today, next week, or never?
Well, it remains to be seen on what kind of fights we're going to see on the House floor. Obviously, one that everyone's talking about is when it comes down in the early summer, when it comes down to raising the debt ceiling. But he cleared a significant hurdle yesterday. He was able to get the rules package over the line, even though you had some moderate Republicans grumbling. One of them did vote no, Representative Tony Gonzalez, but Representative Mace was a yes in the end. So that was a clear hurdle for him, but we cannot be naive. He is very much so a weak speaker at this point, and he has almost given these insurgents in his party a veto power on him. And what French Hill said, Representative French Hill, which I know, Tom, you talk to a lot, he said this really decentralized the power the speakership has.
This is fascinating, and let's use a phrase from the former president. These Republicans in name only, and quite frankly, French Hill may be, and I don't want to allude to that, but Republicans in name only, what is their power now after the theater we saw the last weekend?
Well, you're seeing a divided party. I mean, it was 20 rebels that were voting against McCarthy. The power is what they were able to negotiate with him. Two things, obviously the biggest is the motion to vacate, meaning only one single member could call for his ouster. It was the threat of that kind of vote that Speaker Boehner had to leave in 2015. The second big thing McCarthy did negotiate with, and this will be interesting really for our viewers, is a cut in spending, 130 coming off of the spending budget for 2024, wants to cap it at 2022 levels. This is why these centrist Republicans are concerned, because they're worried that's going to hit some of the defense spending.
How much have you seen a change in tone from President Biden based on some of the internecine conflicts and this question about what he can actually promise, what he can actually get done, with what authority in terms of getting congressional consensus behind him he has as he discusses with his counterparts?
Well, it's the second week in January, and President Biden is in Mexico. I think you'll see the president really lean into his foreign policy this year, because he knows that there is gridlock in Congress, and there's really not a lot he is going to be able to get done. Of course, there's going to be the debates on the must-pass issues, but we already know those must-pass legislation issues, like the debt ceiling, like funding the government, those are going to be very contentious, because obviously we have a divided government with the Democrats controlling the Senate and a thin majority of Republicans in the House, and the Republicans themselves are struggling to agree on basic matters like who should be the speaker. So I think you're going to see Biden really lean into foreign policy, something obviously he talks about with his time on the Senate Foreign Relations Committee. But, you know, it's not lost on me that it's the start of the new year and he's sitting down with the President of Mexico and the Prime Minister of Canada.
How much is the anti-China sentiment still a bipartisan consensus right now, given the potential reopening and the potential business opportunities?
I think you'll see a lot of that. The one thing, Lisa, that Republicans and Democrats, whatever side of the aisle you sit on, this is something that they can agree on. Usually the debates are how they are going to combat it. Obviously, when you think of things like defense, you know, you heard from some Republicans saying that they were going to make a trip to Taiwan. How can they go there if the Republicans themselves are talking about cutting their own defense? What kind of message does that send to their partners and allies like those in Taiwan? But it is politically opportunistic, especially going into 2024, whether or not you're Republican or Democrat, to make sure you are pointing aim at China, which, by the way, is also coming up on the ground here in Mexico City. You know, President AMLO yesterday saying that he's seeing more ships with more goods from Asia ending up in Pacific ports, and that's something he wants to put an end to.
AMH, Anne-Marie, thank you. Over in Mexico City, this trade story, what is it called? Nearshoring.
Yeah.
Nearshoring. Mexico could be a massive winner from that. That's what Anne-Marie's talking about there.
And that's got to be a big tenor of the discussions. Of course, there's still so many disagreements between Mexico and the U.S. that it's not such a clear shot between what we're doing now and nearshoring. That said, how much are businesses going to lead in that? Basically saying we need something that's more secure just in case there is some sort of disruption, and multi-shore rather than just focus on Asia.
We need to get Stiglitz back, Tom. Decades of globalization, lower costs, outsourcing production, and now trying to unwind some of that, and does that come with a bigger price to pay?
It is about the new globalization, John. I'll take your point on that. I think it's really, really apt. I would go back to what Roche invented, which was labor arbitrage. And this is not only China to Mexico, which is frankly pretty ancient, but it's across the Pacific Rim as well. The labor arbitrage to Vietnam, you mentioned Korea earlier. They've owned the high ground on this with Singapore, back to the Tigers. But the labor arbitrage here post-pandemic is an unknown.
The big question for me is whether shareholders are going to allow inefficiencies baked in, or that labor arbitrage to basically be shrugged off in favor of strategically better positioned, and I put better in quotes, kinds of supply chains, because ultimately there's going to have to be some sort of pushback from shareholders if they really do prioritize profits in the near term over everything else.
I would suggest the history is China will aggressively respond to any labor arbitrage.
Well, you try to incentivize it, don't you, with credits? And that's ultimately what's happening in the United States with EVs. And you can already see how controversial that is, never mind China, between Europe and the United States.
Is the EV thing working? To me, I'm not informed on this. A Rivian drove by me the other day.
When you say working, what do you mean by that?
Is the experiment of EV working?
Is there
right
real
now?
demand for it?
Growth, I mean, the cars are really expensive.
And there's massive demand. I think you just have to ask Ford.
You can't get a car, right?
Huge demand. Question I would ask, and there's a risk factor for that industry, and I think a lot of the analysts are on the same page, and it is a risk factor, perhaps the tail risk, is that you invest a ton of money into this for projects that are going to go on for decades, and then all of a sudden, a better fuel comes along.
Well, yes, that's a question. Or the potential for scarcity of lithium and some of the ingredients that go into the batteries to make these. Just want to say this, EV sales nearly doubled from 2021 to 2022. They account for about 5% of U.S. car purchases.
I'm going to run. Matt Hornback and Morgan Stanley.
Like, peace out.
In the next hour. I don't mean run instead of drive.
Did I say something wrong?
No, just I've got places to be, Tom. Morgan Stanley's Matt Hornback on a weaker dollar. Cameron Dawson of New Edge Wealth on why the bull steepener is the thing to be afraid of. We'll talk about that, and we'll catch up with Matt Miskin of John Hancock in the next hour.
Piercing.
started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Bloomberg Surveillance, we say good morning to you. An interesting Tuesday morning. Don't forget crypto this afternoon, New York time on Bloomberg. A really, really tumultuous moment for crypto. Really, I don't even want to go into it because I'm frankly not qualified to go into it. But look to crypto this afternoon for Binance and all that's going on there, including the Coinbase announcement of an hour ago. The number's not a big deal, 950 bodies out at Coinbase, but on a percent basis, Lisa, I'm sorry, that's a large number.
Yeah, what is it, 4,000 staffers or something like that?
It's
So
like
this is a significant
20%
portion.
or whatever.
But what you're dealing with right now is a sort of reckoning in the crypto space, and I do wonder how far that goes, the tentacles of that in terms of tech and tech investments and some of the investment firms that invested in some of these crypto platforms.
Arthur Levitt, I thought, was brilliant yesterday on Bloomberg Surveillance and Radio, the former chairman of the SEC, Bloomberg LP board member, and Chairman Levitt was heated of the limitations U.S. authorities have because of all the shenanigans of foreign domicile and that.
Which raises a question of the trust that people have in foreign domiciled funds and brokerages.
And then the data here, futures negative 21, Dow futures negative 175, VIX giving me no love, 22.45. I'm on the watch for a positive Bloomberg Financial Conditions Index. Right now, we're not going to go into that, but all you need to know, we have seen stunning movement on what is an optimistic set of discussions over disinflation. We forward that discussion now with Kathleen Bostjancic, Senior Vice President, Chief Economist at Nationwide. Thrilled she could join us this morning. Kathy, I want to go to Chairman Powell 30 minutes from now, the Reichsbank. Maybe we get news, we don't. I want you to substitute for Chairman Powell. What is he supposed to say about the gross accommodative trends seen in the different financial conditions indexes?
Good morning, Tom and Lisa. Happy to be with you. I think he's got to be cautious at this point. We're just 2 days away from getting the December CPI report. So I don't think he wants to weigh in too heavily before that number. And as you said earlier, this is not really the right forum for him to make any new pronouncements. But, certainly the dialogue has changed, right, in markets and among analysts that the soft landing scenario has received maybe increased probability now. But I think I'm still in the cautious camp, maybe the Lisa camp, whatever you want to call it. But, as inflation comes down, companies are losing pricing power, right? And that's the way it works.
Well, I've got four questions, but if she's in the Lisa camp, we might as well go to Lisa to talk to Kathy, because Kathy and Lisa are both in the Lisa camp.
Well, but Kathy, how would you push back on some of the optimism that people have about disinflation, about a soft landing, about the fact that you are seeing wages that are starting to come in, even with the unemployment rate going down? How do you push back against that and say, not really, the Fed needs to do more and growth is going to slow and go negative?
Yeah, I mean, it's possible. They never rule out the kind of the miraculous disinflation and the soft landing. You just can't do that. There's so many of uncertainties, and we have to be humble, especially after the past year or so forecasting them. But that said, even if inflation does manage to come down and maybe wage growth starts to ease, even though, as you said, a really tight labor market, the flip side of it still concerns me in that it means companies are losing some of that extraordinary pricing power they've had, which was elusive, right, over the last decade. So that's got to feed through to revenue, profit margins, and eventually to equity prices. Again, you can't rule out that maybe it will be just, somewhat of a softer landing. But, I'm skeptical at this point. We saw the ISM service data on Friday. It was completely overshadowed by the fact that wage growth slowed and more than expected, and also that prices paid as part of the ISM declined a bit. But, ISM services, now we have ISM manufacturing, along with real estate, being in recession territory, probably not long before non-residential investment, kind of joins that camp. So it seems to me the recessionary scenario is still there. I guess the question is really, is it mild, moderate, or something else?
Kathy, you mentioned a lot in there, and there's this divergence right now between perhaps profit margins coming in, the likes we saw at Lululemon, we've seen this at other companies as well, versus an economic downturn that includes a downdraft in the labor market. Could we get a pretty rocky year for equities, kind of like Mike Wilson at Morgan Stanley thinks, because of contracting profit margins, but a resilient economy where the labor market stays intact?
Again, it's possible, but I think it's threading that needle, a little too closely, or it's very difficult to do that. Unless companies really have adopted a different mantra this time, saying, well, it was so hard to hire workers to begin with, we're going to hold on to them, even if profit growth slows and eventually turns negative. I just feel the pressure will be to let go of some of the workers. We saw that in the tech sector. Now, luckily, those workers are skilled enough. They quickly found jobs. I don't think that's true, across the board.
Kathy, you're one of the nation's best at all of these confidence measurements. I'm going to call them soft economics. I don't mean that in a derogatory way. What's our confidence right now in what confidence statistics tell us?
Well, going back to my time at the conference board, and the Consumer Confidence Index is very useful, as is the University of Michigan Sentiment Index.
So what's it say about gloom and doom? What's it say about the Lisa camp?
Oh, my goodness.
Well, I think what it has told us is that consumers are saying, we're feeling the pinch. We don't feel great about the macroeconomic environment, but they had enough reserves, right? The pandemic-related savings, and the labor market was still really strong. So they kept spending. But keep in mind, fourth quarter growth, all of the spending really has been concentrated in October. November paused, right? We had a stall out in consumer spending. So the momentum going into this year is slower. And the savings are being drawn down. And if the labor market turns, even just on the margin, that's going to curtail consumer spending. The question is really the degree of all of these things, right, in terms of whether we get the softer or the harder landing.
Just to be very clear, Tom, I am gloomy about certain things in terms of trying to look at the negatives, and that's just my nature. However, I will say there is this question right now about what if you get a pretty bad situation for companies, but a good situation for the economy, and that seems to be something that's increasingly relevant.
Let me clarify here, folks. The only thing Lisa's not gloomy about are the New York Mets. Other than that, it's straight gloom.
Literally, that is a team for people who like to be gloomy. So yes, that is correct. It's sort of for
Thank
group
God
therapy.
For Mr. Cohen.
But I do want to make a point though, and Kathy was talking about this. The cost of goods sold online, there was a report that came out from Adobe today showing that it actually declined because companies are losing pricing power. There's steep holiday discounts, and you're starting to see that. Kathleen, this is actually a good thing, right? I mean, at what point can the Fed look to this as a disinflation, as a lack of pricing power that will lead to that 2% level by the end of 2023 potentially, or even close to it, the way the credit sites was potentially gaming out?
Absolutely. I mean, the Federal Reserve wants to see price pressures eased. Absolutely. It's just my point is in getting that, as that unfolds, it is going to be hard, I think, for companies to adjust because they are going to lose some of that pricing power, and they are working off some of these high inventories. And if they feel they need to cut costs further, that means there could be some layoffs coming. and that's going to hurt consumer spending. So that's the difficult challenge here, right? How do you get inflation down without really hurting the inflation and the economy? And maybe things are already in play, right? Again, seeing ISM services and manufacturing service index both below 50.
Right.
You don't see that unless you're in recession.
Kathleen, thank you so much. Kathy Bonchachik there on Confidence and Confidence. She's part of the Lisa camp at Nationwide. Joining us now, he is not in the Lisa camp, is Michael McKee. I saw the Broncos for 3 minutes this weekend. Your beloved Denver Broncos. Good luck with that.
It's the Georgia Bulldogs that matter.
The Georgia Bulldogs won large.
Can I just point? Did you either of you watch the game?
No,
See Stetson Bennett, you've heard of, the quarterback, unwanted, unloved, now 2 national championships, and led the destruction of TCU last night. He's an economics major.
Well,
good. There we go.
So let's hear it for the economists.
Are we going to see the destruction of accommodation from Chairman Powell in 20 minutes?
I would doubt it. This seminar put on by the Riksbank is about central bank independence, and it's also a panel discussion. So it's not the kind of venue where you would talk a lot about it.
But if you were there asking a question.
Well, yes, that I was just about to say. There is audience Q&A. If it's just economists and central bankers, they like to nerd out on things like central bank independence, and they don't really ask questions about whether the Fed is going to raise rates or not. But somebody in the audience might.
And what could they ask, and what could Jay Powell say that would disrupt this market after so much hawkish Fed speak that this market has ignored?
Well, disrupting the market might be hard because the only thing you could maybe do in that situation is ask whether you're going to go 25 or 50, and he might give you an answer on that. But everybody knows the Fed's argument is we're going to keep rates unchanged for a long time. Those were the words of Raphael Bostic yesterday. Just 3 words for you: for a long time.
But Raphael Bostic, and that's where I wanted to go, he was talking about how raising 25 basis points at the next meeting looks likely, but not potentially dovish, right? Basically, their end point stays the same. Is that the new messaging here, that don't rally if we raise only 25 basis points? That doesn't mean that we're about to pause?
Yeah, I think that's definitely a message that they want to deliver, and I'm sure that if they do 25, Jay Powell will come out and make that clear in his news conference. Interesting research from Goldman Sachs this morning that suggests, at least as far as they're concerned, that the impact of the Fed's cumulative tightening is hitting the economy right now, that long and variable lags are shorter than people think, which means the economy will be growing faster than people think in 2023, and they'll have to raise rates more than their forecast.
Tell me the next book. Olivier Blanchard wrote my essay of the year next year. He's out with a new book, folks. This is thin, gorgeous Blanchard here versus his intermediate macro textbook, which I read cover to cover twice. This is a really important document, and he talks here about the algebra underlying all of your world. Does Chairman Powell believe in the algebra? Does he have a model right now he can trust?
He doesn't have a model he can trust. However, they do use the models because it's what they have, and it gives them some guidance. But at this point, the Fed concedes, as everyone else does, this is a different kind of recovery. I mean, maybe Stetson Bennett knows the models, but...
You think you better watch some more games just to make sure.
Is this been like the greatest day? The conversations today have been extraordinary.
They have been, well, like they always are.
We finished strong. Olivier Blanchard will join us in the Peterson Institute. That will be absolutely must-watch for Global Wall Street. Futures negative 20. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, JP Morgan CEO Jamie Dimon says that the Fed's rate hikes might need to go beyond what's currently expected. Still, he told Fox News he's in favor of a pause to see the full impact of last year's increases. Dimon said there's a 50% chance the Fed will raise its benchmark rate to 5% and a 50% chance it will go to 6%. The UK's attempt to send the first satellites into orbit from its own soil has failed. A rocket launched from a Virgin Orbit Boeing 747 that took off from England malfunctioned. Now, that led to the loss of its payload of 9 satellites. The jumbo jet and its crew did return safely. After years of drought, California is in a long flood fight. Since the end of December, waves of storms have rolled in off the Pacific Ocean. They've killed at least 14 people, closed highways, and forced residents to flee. On Monday, there was an evacuation order from the town of Montecito, home to Oprah Winfrey, Prince Harry, and Ellen DeGeneres. And Bloomberg's learned that the drugstore chain CVS is exploring an acquisition of Oak Street Health, which runs primary care centers for Medicare recipients. A deal could value Oak Street at more than $10 billion, including debt. Shares of Oak Street are soaring today. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Ago, there was barely any fall to be found on Europe, right? So that's not long ago. That's just starting now, right? That shift is just starting. So I would really expect there is a bit more, a bit more positive, a bit more of a positive run to go for Europe, both on the credit side, on FX, and on equities.
Max Kettner of HSBC with the optimism of HSBC and others, I should say, on Europe. We see it with dollar weaker trend in place. DXY with a 102 print earlier this morning shows the tumult, the change that we see in 2023. Last year, in the shock of Ukraine and Putin and Russia, I named my book of the year in February or maybe the first week of March. It was the absolute must-read, Putin's World by Angela Sten. I'd never had a book of the year that early. And I'm not going to top it this year with Olivier Blanchard's magisterial fiscal policy under low interest rates. All you need to know is this is the definitive short read with the rigor of the Massachusetts Institute of Technology and Blanchard. It is the immediate must read for every economic geek that is out there trying to get smarter, trying to get curious. Blanchard of MIT and the Peterson Institute, the former chief economist for the International Monetary Fund, joins us this morning. Olivier, Lisa's going to vault into your wonderful new book, a short but dense read. I need to go to my essay of the year for last year, which is you late in the year in the Financial Times where you said, everybody calm down. The American public doesn't worry about inflation at 2%, and the new 2% worry is maybe a 3%. What happens to our financial and economic system if we get the level of 3% with inflation? Is that the new 2%?
Well, that's not my decision to take. It's a decision of the central banks. Part of the book is based on the fact that when we had the target of 2%, which we still have, this implies fairly low nominal rates on average, and that really limits the ability of the Fed to help the economy if it slows down. You can only decrease the rates by, you say, the nominal rates are 2% or 3%, by 3%. And what we have seen over the last 20 years is that that is not enough for the Fed to actually do the job, or the ECB or whoever, any central bank. And so I have argued that it might be better to actually run the economy on average at 3%, which would imply higher rates, which would give more room for monetary policy, and would make some of the issues in my book less relevant, because if monetary policy can do most of the job, it should do most of the job. If it cannot, then fiscal policy has to come in, which is the title of
Olivia, and this, Lisa, is so profound. Professor Blanchard at IMF with Stiglitz talked about 4%, and that was hugely controversial in 08 and 09. And this is a bit of a different discussion, as you and I have heard from his colleague at Peterson, Adam Posen.
Right, this question of, do you let it run hot? But on the flip side, and Olivia Blanchard, the title of your book, Fiscal Policy Under Low Interest Rates, Fiscal Policy of Trying to Fuel Growth when Monetary Policy didn't have room to do so, does it get flipped on its head, especially after fiscal policy created the problem that monetary policy is now trying to address?
So, as you may know, fiscal policy can do too much. And I think that we're paying, in large part, the major fiscal policy mistake. There was no need for the very large programs that we saw in 2020, but more especially at the beginning of 2021, which led to very large overheating of the U.S. economy and supply chain disruptions, which would have been there, but were probably aggravated by it. And in general, overheating in the world. So yes, I mean, there's such a thing as using fiscal policy too much. I had the sense that although I was arguing for using fiscal policy, the Biden administration in particular was probably doing two times or three times what I would have liked. And the result has been, indeed, there are some other reasons, and clearly Ukraine has been very high inflation, and the Fed has had to react the other way with very high interest rates, or relatively high interest rates. I think that's a phase. I think that the book is really written looking beyond the current inflation episode, the current higher rate episode. And one of the theses of the book is that we're probably going to return to an environment in which the rate that the central banks need to choose in order to get the economy at potential is going to be very low again. So we're again going to be in this situation in which there might be constraints on the monetary policy, and fiscal policy has to do more. But the point is, clearly at this stage, the discussion is very much about the high rates. So there's a bit of a provocation in coming out with a book where the title of it is Low Rates. But I would argue that first, they're not terribly high. They're surprisingly low at the height of a battle against inflation. And there is no reason to think that they will not go back to something like we had before COVID.
So then where does that leave the Federal Reserve, the ECB, in terms of the balance of risks? Is it to go too far with benchmark rates and hold them there for too long now? Or is it to not do enough, given that we are going back to perhaps something that is slightly different than what we experienced over the past several decades?
So I think that with respect to the inflation process, I'm slightly older than you are. And so I've seen it before. And it seems to me, and maybe Tom is in between us, is my guess. It seems to me that I have seen it before, and the issues are always the same, which is, well, inflation is too high. Part of it is going to go away because part of it is due to energy prices, food prices, and these are going to decline. They have started declining. But, we still have to basically slow down the economy a bit, and we don't know how resilient the economy is, right? In the textbook, or in the simplified stories you hear on the radio, you basically increase the interest rate and the economy just slows down. But you don't know how easily you get to that.
Right.
So I think that's what the Fed, the ECB, and all central banks are facing, which is, should we do more? Should we do less? And then there are two issues, if you give me 2 minutes more. The first one is that there are what we call lags, right? Which is that even if it works, it doesn't work right away. And so you have to kind of stop tightening or going easy before you actually have seen the results, because the results take 6 months or a year, right? And then the other aspect, which I think is relevant in this case, is that some of the factors which increased inflation turn around on their own, independent of the Fed.
47, 49, into the Eisenhower deflation that we saw in 52.
I'm not that old, Tom.
You just, thank you. But Robert Solow is, who you dedicated your book to at 98 years old. Do we have any clue what...
In great shape.
Do we have any clue what we're doing, Olivier, given disinflation in place amid technology? Solow, the laureate Paul Romer, the should-be laureate Olivier Blanchard. Do we have a clue where we are, given the technological progress that Solow invented?
Yeah, I think we do, but there's uncertainty. I think there's the usual amount of uncertainty, which is, the economy is always changing, so you have to take this into account. The response to interest rates changes as technology changes and so on. I think for the moment, we're roughly where we should be. It looks like we have it probably more or less under control. The really difficult issue, Tom, is what is the unemployment rate that we can sustain? Can we basically get inflation down all the way to 3.5 as it is now and keep it there? Or do we have to accept slightly higher unemployment in order to stabilize inflation? And I think that's the big issue. That's where all kinds of technological issues come up, matching, reallocation, all kinds of things like that.
We are out of time. Olivier Blanchard at the Peterson Institute, without question, my essay of 2022 in the FT. And here in celebration, Lisa, I'll read it for you cover to cover so you don't have to read it. Fiscal policy under low interest rates, it is blindingly terse, but very dense. There's a lot of algebra in here.
I love that you handed it to me mid-interview to read quickly before talking with him. Okay, all right. All right, thank you. You did a great job. I understood it all. It was great. No, honestly, his point there, though, is very well taken when we were talking about the balance of risks. It's wrong to just take some of the disinflation that we have seen and say, game over, inflation's dead.
Can you handle this chart? I think Lisa, this is a chart for the Lisa camp here. This is R minus G. Major shout out to Larry Summers and Bloomberg Economics' David Wilcox for pushing Blanchard to write this beautiful, beautiful economic treatise. Stay with us here. Futures in negative 16. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So the inflation environment has been changing a little bit. Inflation's been very low for 25 years. Now people think inflation's coming back. How are you going to deal with that?
I think many of the tools that we've historically used to battle inflation no longer work in the same ways they used to. I think people oftentimes thought of housing as a way, or especially retail and real estate as a way to hedge against inflation. Less and less possible the way we've invested in it. I think commodities similarly have been thought of as a way to hedge against inflation. There are challenges over the long term. Equities have been a hedge against inflation. We will continue to do what we have done in the past, which is build a diversified portfolio where there are many different opportunities that have the possibility of hedging against inflation, because different types of inflation have to be hedged in different ways. So if it's a very quick increase of inflation as opposed to a slow rise of inflation, is it temporary? Is it a long and a persistent type of inflation? So for us, I never model myself an economist that can predict where inflation is going. And so what I need to do is build a diversified portfolio where there are different options that can fight the different types of inflation and to pay close attention to it. And you know, fundamentally, it's done through the equity markets.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Chairman Powell just around the corner, live from New York City this morning. Good morning, good morning. Equities down by about 1/3 on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York City, we begin with the big issues. Some New Year optimism. Morgan Stanley ramps up bullish bets on China. Goldman Sachs drops its Eurozone recession call as the Fed tempers enthusiasm back home.
There's so much bearishness out there right now.
There's simply a lack of downside catalysts, a lack of downside surprises.
There's quite a bit of skepticism.
And therefore, the only way is up.
It does seem as if there's nowhere to go but up.
It's really a sequencing question.
News cycles or bull markets, they start in pessimism, grow in skepticism, mature in optimism.
It's not like we're super bullish.
It's been a fits and starts type of argument.
The only thing I'm going to say is, well, it's not going to be a Rocky Horror show.
It's been incredible how much the market, or how well the market has held up so far.
People are starting to drop recession calls for Europe.
There's a very good case to be made for China assets right now.
The balance of risks are a little bit more balanced than what the market is suggesting at this point.
Attention turning to Fed Chair Jay Powell this morning, delivering a speech at Sweden's Riksbank. For more, let's get to Mike McKee for more. Hey, Mike.
Hey, John, let's get right to the bottom line. There is nothing for you to trade on in his prepared remarks. Jay Powell, on a panel discussion about central bank independence, sticks to that. And he says there's, the speech says there's no mention of the current economy or monetary policy, a short defense of Fed independence. If there's any headline, it's that Powell says the Fed should not try to influence social policy. There's one quote that is kind of interesting. Powell says, without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools to promote a greener economy or to achieve other climate-based goals. We are not and will not be a climate policymaker. Someday, that may be a quote that comes back to haunt him or comes up in some kind of testimony, but it doesn't have anything to do with what the Fed is doing right now. So again, nothing to trade on. That does not mean you can turn this show off. You have to stay with John because you are going to learn something. And, of course, Jay Powell could always say something else, and I'll be back with that.
There is a Q&A session, right, Mike?
There is a Q&A session. Central bankers tend to be nerds, and they like to talk about stuff like central bank independence. So it may not come up in the questions, but the audience does get a chance to ask, and we will find out.
Mike, just a final one from me and from us. There's been a ton of Fed speak over the last couple of days. They're pushing back against rate cut forecast projections from market participants. Mike, is it carrying any weight in this market?
So far, it's not. I mean, we'll see what happens after Thursday's CPI and whether that really sets the market on fire in terms of lower rates going forward. But I refer you back to Raphael Bostic yesterday when he was asked about how long the Fed would keep rates high. He said, quote, a long time. And I think that's the message that we're going to hear from all of them.
Hey, Mike, thank you. We'll touch base with you in just a moment. No talk of monetary policy just yet from the Fed chair, Jay Powell. Equity futures still negative by about 0.2%. With us is Morgan Stanley's Matt Hornback, Matt Miskin of JH Investments. Gents, great to catch up with you. Two quotes here I want to start with. One from Citi, one from B of A. This from Citi first. This came from Andrew Hollenhorst, who had to say this. We continue to think Fed concern about loosening financial conditions amidst tightening labour markets implies unappreciated hawkish risk, including a 50 basis point hike on February 1. This is even more the case after the dramatic decline in Treasury yields last Friday. Bank of America and Mike Gapin followed up with this one. We do not see the Powell Fed as facing a new conundrum. The Fed should worry less about markets pricing cuts in 23. If the Fed commits itself too strongly to no cuts this year, then it risks leaving policy too tight for too long. Matt Hornback, first to you. Which one is it?
Hey, John, thanks for having me on, and Happy New Year to you and your family. Look, I think what is important here is two things. Number one, we have to recognize that market prices do not always equate to expectations. And in fact, if you look at the New York Fed survey of market participants, you can see that market participants do not expect the Fed to cut rates this year, even though markets are pricing rate cuts. That is really important, John, for your listeners to understand. Number two is that when you look at the inflation path this year, markets are pricing below target headline PCE inflation by the middle of the year. Now, I don't think the Fed is expecting that. In fact, I know the Fed isn't expecting that because not a single FOMC participant in the last summary of economic projections was even close to projecting below target headline PCE inflation this year. So we have to understand that this year is going to turn out much differently than what FOMC participants are currently expecting, and that opens up a lot of opportunity for investors, John.
So, Matt, let's talk about those opportunities. I went through your work. Here's a quote from you. Markets and data are starting to challenge the prevailing consensus views among investors and central bankers that post-pandemic inflation will look different than pre-pandemic inflation and that policy will be kept restrictive as a result. Matt, here are the trades. Embrace duration and curve steepness. Sell US dollars. Is that a conviction view this year for you?
It's a conviction view for the first 3 to 6 months, John. I do not think that 2023 is going to be, quite frankly, as easy as 2022 was. We had a year where a handful of factors drove markets in the same direction, more or less, right? So 2023 is going to be a year of multiple trends, multiple opportunities. The first one, yes, we think is to sell the dollar, curve steepeners in the U.S., embrace duration globally.
Matt Miskin, do you agree?
I think the dollar view is going to be a tough one if we get that risk-off environment where we go into a recession and inflation does come down. Now, I understand that weaker inflation could help weaken the dollar. I mean, the dollar has risen as inflation has gone up and Fed tightening. But if we get a recession, we get a risk-off environment, there could be a liquidity crunch. And investors globally and just businesses globally could run to the dollar. And we actually think that could happen in 2023. We like it as a diversifier. It's almost negatively correlated to all financial and real assets. And in 2023, if you do get another sell-off in equities or risk assets, commodities, the dollar could push higher. And we actually would have a modest positive dollar view. But I like the duration call from Matt into 2023.
Well, let's talk about the duration call and what's happening in this bond market right now. 2s10s, the yield curve over the last couple of days has been bull steepening. Why do you think that is, Matt Hornback? Where's that coming from?
Well, I mean, John, look, the markets, are pricing in risk premia. And what we've seen out of the data is that the risk is skewed towards weaker activity data than people were prepared for. I mean, it's interesting at just how the bond market rallied when so many people are in the hard landing camp. I mean, the data is surprising even them. Now, look, the labor market report from last week, John, had something for everybody. If you were bullish on the economy, you had things that you could point to. If you were bearish, you had things that you could point to. For me, what I make of all of that noise, the signal that I take is that incomes are going to slow. Income growth is going to slow. And that is the primary driver of spending growth, John. And at the end of the day, one of the main factors pushing inflation up has been demand. We think demand is going to slow. That should help inflation come down. And that's where we think duration, there's an opportunity here in the first 3 to 6 months of the year.
Well, it's helping yields at the front end come down, particularly on the 2-year. We're down about 25 basis points over the previous 2 days. And Matt Miskin, I've got to wonder why the 2-year yield is down. So in the market, I think for a lot of people, they see 2-year rates. If they're lower, they like buying risk. And I think the next step is to work out why they're lower. So let's talk about that. Are they lower for good reasons or bad reasons? We've seen a 2-year yield, Matt Miskin, come in because wage growth is softening, there's evidence of a soft landing emerging, or are we seeing it for bad reasons because survey data, the ISM manufacturing services, are sub 50 and in contraction?
John, it was almost like you were watching the markets tick for tick on Friday, like the rest of us. Yeah, so on the jobs report, it wasn't the weakened wage growth that actually caused the 2-year yield to fall. After the jobs report, the markets were kind of just sitting there doing nothing. It was the ISM services report missed by a mile. And the new orders component of that, 45, John, 45. And that is when the 2-year yield tanked. And then it was just a spark of risk on rallying. Bad news is good news is such an interesting time to be an investor. And in the cycle, we think this is a late cycle dynamic where bad news is good news. It can only last so long. And John, as you know, earnings season starts out on Friday. And at the end of the day, it's about the profits that come in for companies, for equities. Profits drive equity prices. And I think in our view, the earnings season is going to be a tougher one. The bar is low, but the estimates for 2023 are still too high. We think that's actually going to drive equities to continue to see volatility, multiple contraction, and earnings estimates to come down over 2023. I know that was jumping off your 2-year yield, but bad news is good news, is helping lift risk assets for now, but it can't do so for too much longer.
Well, Matt Miskin, to your point, is the bar low enough going into earnings season? Mike Wilson started the week over at Morgan Stanley by asking, how might the consensus be wrong? And he said it's not directional, it's basically about magnitude. He thinks that the earnings season is going to be terrible. Maybe we have an extra 20% plus downside from here. HSBC, Max Kettner, said this morning. Here's the quote from him. Having been staunch bears for much of 22, we think the consensus is wrong about a weak first half and second half rebound. We see a variety of reasons to be less bearish on risk assets in the first half, with depressed growth expectations being key. We actually caught up with Max a little bit earlier this morning. Here's what he had to say.
But we look at market pricing, so we look at things like equities versus rates. We look at equities versus rates against PMIs, or equities versus fixed income, comparing that against break-evens, so cross-asset relationships, or cross-asset against macro relationships. All of that looks a bit more, a bit more realistic now. And I think one thing that I would say is it's not like we're super bullish, right? It's not like I'm saying, growth is going to go through the roof and it's going to be rock and roll. The only thing I'm going to say is, well, it's not going to be a Rocky Horror Show.
Matt Miskin, what do you make of that?
I think the toughest thing when I hear a lot of investors think about the expectations, look at earnings estimates, because that is the consensus built in. Earnings estimates for Q1 and Q2 are actually modestly negative. So if anything, that's the lower bar. The higher bar in Q3 and Q4 come into play. Analysts are estimating a massive earnings boom in the back half of 2023. And right now, it's the consumer discretionary sector, industrials, and financials. 3 massive cyclical sectors that are supposed to drive earnings growth in the back half of 2023. That's where the bar looks too high in our view. It overall looks too high. It just seems like right now the bottom-up consensus is for a economic recovery right through 2023. We think that's overly optimistic, given leading indicators, given the inverted yield curve, and given that PMIs are sub 50.
Matt Hornback, I want to give you the final word on this before we talk about EM, China, and Europe in just a moment. Matt, when you look at US growth expectations, are they still too high or are they low enough?
No, John, I think they're low enough. And where I think that growth expectations are probably more consequential for macro markets, including the US dollar, is when we look outside of the United States. If you think growth expectations are low here in the US, just look at Europe, look at Asia. Our view has been that China is a positive growth story for this year, and that's going to have lots of spillover effects to Asia more broadly, but also to Europe, John. And if you just look at natural gas storage in Europe, it has massively outperformed expectations. So all of the concern that was building up in the back half of 2022 with respect to the winter in Europe of 2023-24, you know, there's lots of scope for growth expectations to rebound outside of the United States. And that's another factor that we think ends up weighing on the dollar this year.
We're going to talk about that next. Matt Hornback, Matt Miskin, sticking with us. Equity futures right now down about 0.2% off the lows. No real mention of monetary policy from Chairman Powell just yet. When the Q&A session starts, Mike McKee's going to jump back onto the set and run you through some of the headlines. Coming up, looking past the US for outperformance.
There's a very good case to be made for China assets right now. The dollar has topped in our view, and that is absolutely tailwind for the rest of the world.
That conversation up next.
Consumers are very aspirational. You've got millions of people riding motorbikes, and they want to be riding inside cars. Vingroup, Vietnam's biggest conglomerate, has really tapped into that. The founder and chairman aspires to be the Elon Musk of Vietnam.
Vuong is Vietnam's richest man with outsized ambitions. He wants to sell cars not only to the Vietnamese, but also Americans and other consumers around the world.
If VinFast is successful, that goes very well with the ambition of the Communist Party of Vietnam. But if they fail, it will be very, very hard blow to Vingroup and also to the national economy.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
European equities more than US equities, really like also EM and Chinese equities. Against the backdrop of Chinese reopening, just heard a bit of a pretty bold call around China growth. That's starting to happen now. People are starting to drop recession calls for Europe and for the Eurozone. All that really should be continuing in the next couple of weeks. And as that reappraisal really continues, that should be beneficial for EM equities and for European equities.
EM stocks back in a bull market. China's reopening giving a dose of optimism for Europe as well. Morgan Stanley ramping up bets on China, saying the following: we believe the market is underappreciating the far-reaching ramifications of reopening and the possibility that a robust cyclical recovery can occur despite lingering structural headwinds. Goldman dropping its Eurozone recession call. We no longer look for a Eurozone recession reflecting better growth momentum, sharply lower natural gas prices, and guess what? An earlier China reopening. Maria Tadeo joins us now out of Brussels. Maria, what a change in a couple of months.
Listen, Jonathan, what a change, because the European story was completely battered after the war in Ukraine, and today we have a change in tone, pretty much dramatic with that note from Goldman Sachs. They dropped their call for recession. They now see growth of 0.6% this year. It's not great, but nonetheless, it is growth. They cite all of the factors you referred to, the fact that we did not get this winter from hell. The temperatures were actually pretty mild. The storage, the fact that gas prices have really come down, and then this idea of of China reopening being good for Made in Europe. By the way, Deutsche Bank also had a similar note today saying this China reopening is positive for the euro. What I would stress, however, is now I just had a conversation just 5 minutes ago with the Belgian Prime Minister, who told me, yes, the worst case scenario has been avoided, but we want to see this feed to the real economy. We want to see consumer confidence go up. We want to see bills go down. And of course, inflation past peak become stable. This has been a real headache for European governments this year.
Hey, Maria, thank you. Great reporting over the last year, for that matter, the last several years, but of course over the last few days off the back of this story. Maria Tadeo, thank you. Over in Brussels. Back with us, Matt Miskin, Matt Hornback. Now, Matt Miskin, this is tough for a lot of people to listen to. They're trying to work out, should we be pricing an economic slowdown following tighter monetary policy in the West? Or should we be pricing a growth rebound off the back of China reopening? Which one is it?
It's a macro battle, and it's going to keep playing out here in the near term, and it's brutal. It's back and forth, and you're seeing, at the end of the day, our view, central banks are going to win it out just because they are more powerful on the global economy. And it's almost like right now there's two sides of a boat where people are rowing in different direction, because fiscal policy in China is continuing to provide stimulus. So we're seeing 9% of GDP being used to stimulus, a lot of credit issuance, debt issuance coming on the market. Every night you hear about China reopening, China stimulus. It's like they have a headline machine that just comes out every night, stimulus, stimulus. And lo and behold, Chinese equities are rallying, and you're seeing copper getting a bid. Germany also is going to be issuing the most debt in history, or in modern history, for their economy into 2023 to help mitigate this. It's amazing. But I'd say a lot of good news is priced in. I get it. It's better than the worst case scenario. But right now, if local currency equities in Europe are only down 5% off all-time highs, if earnings estimates continue to ratchet up, a lot of good news is being baked in, or I'd say the worst case scenario is being really taken off the table. We still see the U.S. going into recession. There's not been a period where the U.S. has gone into recession and it did not bring the global economy with it. And if that does play out, it still means weaker growth globally. Earnings likely need to come down. In our view, staying more defensive is a better tack through this challenging environment.
Can we get a DM-EM split? I think that's the question for many people. BlackRock and Whaley have this to say on that. We see DM economies facing recession. They go on to say DM central banks will halt rate hikes when economic damage is clearer. China's reopening and domestic spending will drive global growth as DM recessions hit. We like EM equities over DM, and we like high-grade credit. Matt Hornback, I want to come to you on that. Can we get that DM-EM split this year?
Well, John, I mean, I think it's probably even more nuanced than that. It's not clear to me that, those bucketings are really helpful for investors, given that there's so many opportunities out there this year relative to last year. I would say, with respect to the U.S., look, the economy is slowing, no doubt. And in fact, when it comes to fiscal policy, later this year, it's going to be a showdown, right? We just got a Speaker of the House. We know some of the concessions that were made in order to achieve that are going to make the battle over the debt ceiling more difficult to win towards the end of this year, John. So the fiscal trajectory in the U.S. could actually look much worse as we make our way through this year, versus what Matt said about the China fiscal policy and Europe fiscal policy. Those are pushing in a different direction in large part. So for my perspective, it's really the U.S. versus the rest of the world. And there, I think you can have some differentiation, which is, again, another reason why I think, the U.S. dollar can go down as global growth outside of the U.S. picks up.
That's an important distinction to make. And I want to go to you on that, Matt Miskin. The dollar weakness that you could get off the back of global growth exploding is rather intuitive, but you think perhaps we can get some dollar strength. Matt Miskin, how does that come about?
I think if the Fed really pivots and basically cuts rates, and the ECB actually raises rates right through it, yeah, I think that the dollar could weaken on that. I do struggle with a weaker global growth environment and the dollar going down. I think at the end of the day, it's more of a risk-off currency. It is more of a higher quality currency on a global basis. The euro has been on fire. It likely got oversold into the third quarter. I mean, the dollar last year in the first 3 quarters, that was the biggest move of any calendar year in history. It was up 18 to 19% in 3 quarters. It still was up 8, even though it lost 10 in the fourth quarter. But that dollar move, we're probably not going to get that big of an FX regime where that much currency movement is going to drive cross-asset into 2023. We probably had a lot of that pulled into 2022. But in our view, we think the Fed's going to stay relatively tight. The Bank of Japan's still doing QE like crazy. The ECB is likely to raise rates, but probably going to have to pause after weakening growth filters into the economy. And so we've got more of a modest positive view on the dollar for now.
Hey guys, this was great. Matt Miskin, Matt Hornback to the two of you. I'll say Happy New Year just one more time, Matt Hornback, because you said it and I felt rude, but Happy New Year. And then we're done. Coming up the morning calls and later, all eyes on a 2-year. Cameron Dawson of New Edge Wealth, looking to the short end for signs of recession. That conversation around the opening bell.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Equity futures here just a little bit softer, down 1/10 of 1% on the S&P. Let's get you some morning calls just briefly. Give you 3 of them. Here's one. Morgan Stanley cutting Boeing to equal weight, 220 price target, expecting a return to fair value following recent outperformance. That stock is down by 2.7%. Barclays downgrading HP Enterprise to equal weight, $18 price target, citing caution on IT hardware due to a challenging macro backdrop. That stock's down by 1.6%. And finally, Mizuho upgrading Exxon to buy, 140 price target, seeing value in the sector and potential for strong free cash flow. Positive there by about 0.6 of 1%. Coming up, looking for signs of a recession. Where are they? Cameron Dawson of New Edge Wealth focusing on the short end of the curve as the so-called bull steepener starts to kick in. That conversation just ahead, the opening bell just around the corner.
of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan's society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is Bloomberg.
– 24 seconds away from the opening bow this morning. Good morning to you. Equity futures just slightly softer, down 0.2% on the S&P. On the Nasdaq, down about 0.4%. Chairman Powell speaking right now on central bank independence. The Q&A session should start shortly. And when we get that, if we get some headlines, Mike McKeel will run to the studio for you. There's the opening bow. Switch at the board and get to the bond market. Big move at the front end over the last couple of days. The previous 2 days, the two-year yield down about 25 basis points. Trying to bounce here now on a 10-year yield up 5 basis points to 358.36. In Euroland, euro dollar 107.50, euro dollar firmer by 0.2% on the euro side. Goldman earlier this morning dropping their recession call, and all of a sudden some optimism around the eurozone. We'll see if that sticks. Crude 75.40 at 1% at the moment on WTI. One stock to watch around the open is Coinbase, the crypto exchange initiating another round of layoffs and cutting 20% of the workforce. The CEO, Brian Armstrong, writing in a blog post, over the past 10 years, we became too focused on growing headcount as a metric for success, especially in this environment. It's important to shift our focus to operational efficiency. Abby has more. Hey, Abby.
Hey, John. Yeah, and it's interesting because Brian Armstrong was also saying that this is the first time that there has been a downturn in the crypto space along with a macro downturn, sort of suggesting that that's a piece of what's going on. But one analyst at Oppenheimer saying that the reason that this company has now cut over the last 8 months in terms of company headcount for a third time, it has everything to do with the idea that volumes at their crypto exchange are down, especially after the FTX blow up. The stock, it's interesting, is higher today, up 1.7%. So maybe some relief on a stock that's down more than 85% since its IPO. The current cut about 20% or 950 staff. They cut about 1,200 people last June. They also cut 60 people somewhere in between. So more than 2,200 people over the last, let's call it 8 months or so, again, having to do with this slowdown in crypto trading. And they are cutting special projects. As a result, they're taking about $150 million in restructuring charges. So this is no small matter. And net income, back in 2021, when they did go public, they were putting up really solid net income of greater than $1 billion in 2 quarters, and in one case, close to $2 billion. Well, we're now looking at yet another quarter of negative net income. The crypto winter simply continues here, John. Very clear for Coinbase. But again, the stock is higher, so maybe find a little bit of relief.
Higher and keeps climbing. Abby, thank you. Now up by 8% on the session, 2 minutes into the open. Right now, equities almost unchanged on the S&P 500. Up 0.1% on the S&P, on the Nasdaq, up 0.1% also. The restructuring we're seeing hitting firms across industries here. Apple's said to be looking at Broadcom, replacing those chips inside its devices with in-house components in 2025. With the latest reporting, here's Ed.
Yeah, good morning, Jonathan. We're down a percentage point on Broadcom. Not as severe as the reaction that we had when those headlines crossed. According to sources, what Apple will do is move away from the Wi-Fi and combined Bluetooth chip or modem set that Broadcom provides to Apple. This is actually a bit of a surprise because only back in December, Hock Tan, the CEO of Broadcom, talking about how good their chipsets were, how good their tech is. Less of a surprise is Qualcomm, because we've been talking about for a while how Apple wants to move away from Qualcomm. They've been in legal proceedings against them, and then as licensing settlement, which would lead to Apple having a 6-year period of cellular modems from Qualcomm, but then moving away in the future. Look, this is a big technological story, all right, about the modern day handset and Apple's move to bring not just supply chain, but do it itself on the technology front as well. We know that they're considering, generally speaking, how and where their handsets are assembled globally, but this is about controlling the IP and controlling the ability to update technology at a pace that suits them. For Broadcom, this isn't good. About 20% of their revenue comes from Apple, or about $3 billion. They account for around 7% of EPS. You see a lot of reaction on the sell side saying that the timing of this report is very interesting because Broadcom's most recent multi-year agreement with Apple expires later this year. So interesting move, fantastic reporting from Bloomberg's Mark Gurman. Less as a surprise, as I say, on the Qualcomm side.
Just to come to you on Apple just briefly, early February, we get the earnings from them.
Yeah.
The stocks put a run of gains together over the last few days. Tough month, though, over the last month. Yeah. Can you tell me just how low that bar is for that company?
I mean, December was the worst month for Apple going back to May of 2019, and there was a complete revision for that full year 22 forecast in terms of overall handset shipments by a factor of around almost 20%, right, when you take into account all the different reporting around cuts. Ultimately, there is not demand for the lower-end products, and there is demand for the higher-end products, which they couldn't produce because of COVID disruptions in Zhengzhou. So it's going to be interesting to see not just the top-line result, because those ASPs may come down, which will impact revenue, but also margins as well as they kind of scramble to untangle everything.
Ed, thank you, mate. Looking forward to your coverage on that story. February 2nd is when we get Apple earnings. After the close that day, that stock is up by 0.8%. In the near term, we're just days ahead of bank earnings in America. Jefferies reporting a profit decline of 57% in its 4Q results. Shanali Basak on top of the story. Hey, Shanali.
John, you have to wonder if Wall Street's windfalls are now over and how long those windfalls are over for. You have a firm like Jefferies where you're watching investment banking activity fall off. However, you also have them saying that this is still one of their best years they're ending on ever, as well as activity levels not really going back to where they were in 2019. Still, Wall Street does not love it, because once you have activity start to drop off in that kind of way, you have a different equation in terms of how you meet margins, how you turn a profit when you're not willing to let people go. When it comes to Jefferies, they are still trying to send that signal that they are holding on to staff. They are looking for great staff. And of course, that report of Sumitomo a couple of days ago potentially increasing their stake. Jefferies itself did not answer to that. But at a time like this, competitive business on Wall Street, at a time like this, you like to make some more friends to drum up more business. Now, John, what does this mean for the banks that are coming up ahead? Jefferies, yes, the investment bank, no shocker, their activity falling off. But when you look at equities, also under pressure. Fixed income is the big winner here, which bodes really, really nicely, of course, for JP Morgan and Goldman Sachs, potentially even Morgan Stanley next week. Let's see if that's enough to keep the boom times going for these banks here, and whether it's enough to ink them some more money at a time where so many business lines are under pressure.
It's slightly unfair of me to ask, but if you could have one earnings report release right now from any bank on Wall Street, Shanali, who would it be?
You know I love my children equally, but, you know, I think that it will be interesting to see what the big consumer banks do. Those provisions for loan losses are expected to tick higher. And the question then becomes how much. We know investment banking is under pressure, but what about the consumer?
That's a good dodge, a very good dodge, Shanali. Looking forward to your reporting later this week. Thank you. 6 or 7 minutes into the session, the Q&A session just starting with Chairman Powell over at the Riksbank, the Swedish central bank. Mike McKee's going to drop by in about 5-10 minutes regardless, just to run you through what we're hearing from there. The takeaway so far, not hearing much. About 5 or 6 minutes into the session, call it 7, up 0.25% on the S&P, on the Nasdaq, up 0.4%. Looking cross-asset right now, you've got high-yield spreads tighter over the last several weeks. You've got EM absolutely ripping. You've got the dollar weaker. It does not scream global recession. Corporate America could be bracing for a slowdown, and Cameron Dawson, the New Edge, is looking for signs of the downturn in the Treasury market. She says this: Is the re-steepening of the yield curve, that's the one to watch. When the short end is falling, that is the best indicator of an imminent recession. Cameron, I'm pleased to say, joins right now. So Cameron, the jargon for this is the bull steepener. You get that big rally at the front end, yields drop more there than they do at the long end. That's what we've seen in the previous couple of days. Cameron, can you tell me why that's more important than just, say, pure inversion, which is what people obsess with?
Yeah, because the inversion of the yield curve tells us nothing about timing. It can lead a recession by as much as 24 months. It really is that re-steepening that tells us when we're about to enter a recession. And importantly, we've never seen risk assets bottom before that re-steepening begins. And so what that re-steepening means is that it has to come from lower front end yields, meaning that the front end of the curve is pricing in a lot of interest rate cuts by the Fed, meaning the economic condition is weak enough to justify the Fed moving much more easy, much more accommodative. But what's interesting is that if we look at the 2-year yield today, sitting at about 4.2%, that is below the projected Fed funds rate. But importantly, that 2-year yield is right on top of the Fed's own projection of its yield in 2024. That's the median dot in 2024. So it really will be important to see if we see a further rolling over of 2-year yields. That's when the market will be truly concerned that we're going into an imminent recession.
Cameron, how well aligned do you think that bull steepening is with what we're seeing elsewhere? EM absolutely ripping, the dollar weaker, high yield spreads in America much, much tighter. How well aligned are those things?
Yeah, I think you're exactly right, which is that the data does not support that we are going into an imminent recession, which is why we don't think that we've really seen that bull steepening kick off in earnest. And the reality is that data within the U.S. simply does not support the Fed easing policy. And so we think even though we're not getting those hawkish comments out of Powell today at this meeting, we would expect further hawkish comments out of other Fed members as we go into the next Fed meeting in early February, simply because financial conditions, as you said, the dollar weakening and markets rallying, credit spreads tightening, they're all indicative of financial conditions now being as easy as they were back before the Fed's meeting back in August at Jackson Hole. And so that's when Powell really pushed back hard. And so we would expect further pushback again.
Well, Chairman Powell speaking right now in a Q&A session. One line here, the Fed tools work. One tool for the Fed, Cameron, has been Fed speak. And I just wonder how powerful, how efficient, how effective that Fed speak has been over the last week, because they all sound hawkish. And as you've indicated, the 2-year yield has started dropping in the face of that. This at a time when we've got sub-50 ISM readings as well. Cameron, do you think this market's responding to this Fed speak in a different way?
Well, I think we're locked in this really tough game of chicken with the Fed, because the bond market is still pricing in those 40 basis cuts into the back half of this year. And if you listen to Bostic yesterday, he said, I'm not a pivot guy, and asked how long he would keep rates high. He said a long time. And so the bond market completely disagrees that the Fed can hold its resolve and keep rates really tight. And it really is a question of if we start to see hard data start to roll over, because all of the weakness that we've seen within economic data has really been within soft data, survey data, sentiment data. It hasn't really showed up in real activity yet. And I think that's the big question for the Fed as we move into the next couple of months. Will we see things like jobless claims really tick up? Will we start to see income soften even further? And as of yet, we're not seeing that yet, which is why the Fed continues to talk so tough.
Well, Cameron, can I ask you a question that I asked our panelists a little bit earlier, Matt Hornback and Matt Miskin? I think it's an important one. What would you tell investors to position for? Should they be pricing an economic slowdown off the back of all this tightening, or an economic rebound off the back of China reopening? Which one is it?
That is such a great question. I think our preference when we're positioning is to try to be as agnostic to that path as possible, meaning buy companies that you can hold through different market cycles, quality companies that don't need the Fed being super easy in order to bail you out. Because we don't think the time to add beta in liquidity is really until you see a true pivot to accommodation by the Fed. So it means keep a little bit more defensive. You can layer in some cyclicals, but it has to be quality. So for example, we added a little bit to materials. In the event that you do see a reacceleration in global growth, you do see a weaker dollar because of because of China reopening. And so I think that you have to be positioned for multiple outcomes, but the one we do not expect is a really easy policy shift in the very near term.
Favorite sector right now, Cameron? What is it?
So we like the combination of financials right now simply because of very, very low expectations. If you look at who has the easiest bar for earnings growth into next year, it is those financials. They saw their earnings decline 17%. Look at Jefferies in the fourth quarter, down 50% in earnings. That just creates an easy bar for earnings growth this year. And then we like to pair it with some more defensive sectors like healthcare, because we do think that in the event we do have an economic storm, you want some stability within the portfolio to be able to have stable earnings in an uncertain environment.
Hey, Cameron, thank you. This was great, particularly on the bond market. Enjoyed that. Cameron Dawson there of New Edge. Thank you very much. Your equity market looks like this about 13 minutes into the session. We're positive a little more than 1/10% on the NASDAQ, up 0.2%. No big headlines just yet from Chairman Powell. Mike McKee's going to jump on set in just a moment. Coming up, we'll talk politics as well. President Biden turning his focus abroad amid pressures at home.
All options are open. I mean, this is why we have, CUSMA in Canada, USMCA in US, and TMAC here. I mean, it's an agreement that also provides for mechanisms for dispute.
That conversation up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The NEC was started under President Clinton, and Bob Rubin was the first person to hold that job. Can you explain to people what it actually does and what the NEC does day to day? When, for example, who's in the NEC, who's on the NEC, what is your job actually to do?
So the National Economic Council, the job, the mandate, the mission of the organization is to coordinate economic policy across the executive branch and across the cabinet to make sure that the president is getting the benefit of when making decisions of his entire economic cabinet, and also that the economic cabinet is getting clear direction from the president as well. So that two ways. So it's a coordination function. On the NEC itself are all of the relevant cabinet members, the sort of core economic team, OMB, Council of Economic Advisors, Treasury, but also Secretary of Labor, Secretary of Commerce. My team, the NEC team, is a small team within the White House that is, our job is to do that coordination across the range of economic policy issues.
Now, you were the deputy in the Obama administration at the NEC, now you're the director. Which NEC worked better, the Obama administration one or the Biden one?
Well, on the issues that I worked on in the Obama administration, it worked very, very well. And the current NEC works very well as well.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
options are open. I mean, this is why we have, CUSMA in Canada, USMCA in US, and TMAC here. I mean, it's an agreement that also provides for mechanisms for dispute. But of course, as trading partners, and trading partners that are like us, Canada, US, and Mexico, who do enormous trade volumes. I mean, I would say that this is one of the most successful trading relationships in the world.
President Biden in Mexico City for the North American Leaders Summit. Amid mounting tension at home, the DOJ reviewing classified files found in the president's former office. Plus, the White House facing questions over former President Jair Bolsonaro's presence in the United States. Team coverage starts right now. Bloomberg's AMH in Mexico City, Emily Wilkins down in D.C. AMH, walk us through the agenda today.
Well, Jonathan, first we're going to have a bilateral meeting just between President Biden and Prime Minister Trudeau. And then, of course, the Three Amigos, what they're colloquially known as, this is the North America Leaders Summit. They'll meet together. And already from what the White House is saying in terms of their fact sheet of deliverables, we can get a little bit of a sense of what they're going to be speaking about. Semiconductors plays a huge part in these discussions. They want to initiate a new semiconductor forum. They want to look at the labor intensity and the labor needs in terms of the workforce in North America to work in the semiconductor space and also shore up and integrate those supply chains a bit more. They're also going to talk about climate change, not just reducing emissions, Jonathan, but plans to install electric vehicle charging stations along their borders. And then finally, of course, migration, which is a huge issue back in the United States. They're going to try to coordinate more, share more intel and information on migration and on drug trafficking. When it comes to migration, Jonathan, they will be announcing a new portal for individuals who want to come from South America to apply to either go to Mexico, United States, or Canada.
Anne-Marie, just on trade, nearshoring has been a massive theme for a lot of people looking out to 2023, the year ahead, and for that matter, the decade ahead. Mexico, the big winner there.
They are a big winner. Already we see Mexican exports to the United States increasing. And AMLO didn't mince words yesterday with President Biden, talking about the fact, though, that he still sees ships from Asia with goods from Asia showing up in Pacific ports. And he really wants the United States to have more investment in Mexico. He wants the U.S. to not just back them when they go to development banks, but also jointly approach companies to build more in Mexico so they can supply the parts needed for, say, a manufacturing plant in Arizona.
Emily, that's the situation abroad in Mexico. Can we talk about the situation at home? Can you explain this to me? So we've got these files at the former president's office, and now we've got the DOJ reviewing classified files found in the current president's former office. Can you run us through that?
So when Biden was vice president, he did have a role at Pennsylvania University. He had an office that he used, and Biden's lawyers said that they found, I know, right, that they found these classified documents in this office in a closet. They said they have notified the National Archives, which are now in possession of the documents, but of course, this raises questions about what Biden was doing with these documents. It raises a lot of concerns given how much hand-wringing there has been over the documents found at Mar-a-Lago. And I think this really opens up a lot of questions. This is not going to be the last that we hear of it. Republicans are more than ready to begin a number of investigations today. They're going to be looking into things including China, the origins of COVID, Hunter Biden's laptop. Expect to hear more of that. And this is something that they can very easily add to the list of things that they really want to dig into.
I can't keep up. That's your job, not mine, I guess. Emily, down in D.C., Emily Wilkins, thank you. MH over in Mexico City, Anne-Marie, thanks to you as well. Fed Chair Jay Powell, for those of you following, participating in a conference at Sweden's Riksbank. Mike McKee back with us for more. So, Mike, it's about central bank independence. There's a few of them sitting around facing some questions. Have we learned anything so far, Mike?
Nothing really. There is a question just posed to Jay Powell about liquidity in the system, and he says that he would prefer that we focus on structural reform rather than liquidity reform, but that's the closest you've gotten to anything on perhaps some kind of monetary policy. He was asked about whether the Fed felt the policies that the Fed followed during the great financial crisis and the pandemic crisis had worked, and he said yes, but that was in the context of changing policy so that Treasury had to be involved. So Treasury had to approve the methods that they used in the pandemic response. So it's still really all about central bank independence so far.
Well, Mike, you'd have to think they could ask a question here about the need of central bank independence at a time that they're explicitly telling us they're trying to put unemployment higher to get inflation lower. Don't they need independence to achieve something like that?
Well, he did say that central bank independence is helping the Fed because they have to make unpleasant decisions, things that people will disagree with to get to price stability, and price stability is the ultimate goal for the Fed. But you also have to remember this is a panel with 4 central bankers on it, or 4 current or former central bankers on it. So Powell is not the main focus, and he doesn't get all the questions.
And maybe you're not getting the diverse views you might be looking for. Mike McKee, thank you. Hugely controversial, that effort, I know, for many of you at home and beyond. 22 minutes into the session, equities down 0.1% on the S&P, the Nasdaq lower by 0.1% also, with some sector price action. Here's Abby.
Well, John, a little bit of a sleepy day here for sectors, and that small decline for the S&P 500 right now, fluctuating. It has been fluctuating in the first half hour of trade on below average trading volume. This means that we do not have any sector trading. Well, we right now have utilities up down just a little bit more than 0.5%, but across the board, very small moves. Utilities down. This, of course, as yields are higher, making those dividends look less attractive. Healthcare is up top, discretionary up just slightly. Let's take a look at one tech sector that's moving just a little bit more, and that, of course, the chip sector. The stocks down about 0.6%. Broadcom, as Ed and you had been discussing earlier, Apple planning on making its own components. The stock down about 3%, but not so much. I can remember reporting on that possibility all the way back in 2016, 2017. So there's been a lot of knowledge of that in advance. But yesterday, this sector had a pretty good day. Today, giving back a little bit of those gains, John.
Abby, great work. Thank you. Over in Sweden then, bit of a snooze, quiet, not much news whatsoever. You know your next stop. CPI on Thursday, earnings on Friday. Your trading diary up next.
Is there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became Prime Minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done to, quote-unquote, revitalize Japan.
Right now, 3,900 on the S&P. That's the level that Mike Wilson says is an easy sell. Are you a seller of this? Equity futures right now, or rather equities, are up by 0.25% on the S&P. That's the price action. Let's get you the trading diary. President Biden speaking alongside leaders at Canada and Mexico at 4:45 Eastern. Fed speak from Harker Bullard barking on Thursday. Plus, CPI data just around the corner. Jobless claims as well. Then on to Friday. JP Morgan, Bank of America, Citi, Wells Fargo, all kicking off big bank earnings at the end of this week. From New York, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
consumers are very aspirational. You've got millions of people riding motorbikes, and they want to be riding inside cars. Vingroup, Vietnam's biggest conglomerate, has really tapped into that. The founder and chairman aspires to be the Elon Musk.
Sell cars not only to the Vietnamese, but also Americans and other consumers around the world.
If VinFast is successful, that goes very well with the ambition of the Communist Party of Vietnam. But if they fail, it will be very, very hard blow to Vingroup and also to the national economy.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud, The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and in the hotel, eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be